Well, greetings and salutations, test takers. This is Dean Tinney, aka the Series 7 Guru, coming to you from my studio in fabulous Las Vegas with something new. We have done explications in the past with people, students, a student, but we have a syndicate that was formed to do tutoring and practice questions. And so we'll be taking this practice test as a group. So we'll see how that works out. And I'll be reading the question. We'll let people put in chat or however they'd like what their answer is, and then we'll talk about it. We'll talk about right answers, wrong answers, that kind of thing. We'll see how long it takes us. But good news for you, you guys can always hit pause, take a break. I'd hit pause, answer, hit play, see how you did. Kaplan, shout out to Kaplan. Kaplan, you can get a QBank if you don't already have it. I think it's a great paid supplement. Best free supplement is my YouTube channel, but if you're looking for a paid supplement with my Guru 15 discount code at checkout, you can get a Kaplan QBank for $55.80. It has over 3,500 questions. It has a performance tracker, and you can create these simulated exams like we have. And for that commercial, Kaplan allows me to give you a free look on Kaplan content, and off to the races we go. Question one, which of the following analyzed corporate financial statements and trends in sales and income?
Did you
Any
say we're
answers?
putting it in the chat?
You put it in the chat, you can say it out loud, however you'd like to do it.
Okay, I'll just put it in the chat.
That is correct. It is a fundamentalist. A fundamentalist is not a member of the religious right. A fundamentalist is somebody who looks at the economy, the industry, then a stock, does top-down analysis, or the stock, the industry, the economy, bottom up. And they're looking at it, in this case, the balance sheet, the income statement, statement of cash flow. Those are called financial statements. And so indeed, that's right. There's no such thing on Series 7 as chartist. That'll never be the right answer. And there's no such thing as market timers as a right answer on the test. It's either fundamental analysis or technical analysis. All right, number two, we're off to a good start. The FINRA 5% policy deals with markups, markdowns, and commissions. When acting at a dealer, what prices are used to compute the firm's markup or markdown? Yeah, that's called the inside quote. The inside quote, I don't think it'll be based on this scenario, but you definitely should know the inside quote. The inside quote is indeed the highest bid and the lowest ask. That's called the inside market or the inside quote. I would definitely know that. I would definitely know the 5% policy doesn't apply to the primary market. It only applies to the secondary market. I would know that the MSRB does not have a 5% policy. The MSRB version of this rule is that whatever you're charging should be fair and reasonable, should not be unfair and unreasonable. So we are 2 for 2. All right, ladies. All the following are required of municipal securities customer confirmations except. So what does not have to go onto the confirmation? What does not have to go onto the confirmation? Yeah, it looks like we struggled a
I want
little
to
bit.
say A. That's what I would
Yeah,
put.
that's exactly right. It's not your business what I paid for that into my inventory, right? So A is the correct answer, right? I have to tell you the markup or markdown on a principal transaction. By the way, that's called capacity, very testable. I have to tell you capacity, what are after my broker agency capacity, my dealer principal capacity. That's C, right? And D, definitely. So the choice there is A. That was a little tougher. And oh, there you go. I didn't check the chat just to make sure you got it right. Which of the following statements could legally appear in mutual fund advertising or sales literature? Which of the following statements could legally appear in mutual fund advertising or sales literature? Boy, you better not say. Listen, if you said A to this answer, if you said A, that it would be appropriate to say the fund never yielded less and will continue to do that in the future, you should flunk the entire test immediately. Because what are you supposed to say about the future? Nothing. My crystal ball is broke. All I can talk about is past performance. Certainly, we're dedicated to giving you the very best service. That sounds reasonable. Our growth funds NAV will increase faster than general market. Oh my goodness, absolutely not. Our management is unequaled in the investment industry and pushing it. Given that answer set, I think B would be our best answer, right? Our managers are dedicated to giving you the very best service. Under the Securities Act of 1933, now remember the way we distinguish sometimes between prospectus act is with paper prospectus, right? 33, 34 is paper and people. And sometimes that can be helpful in terms of us trying to decide what it is that we're being asked about, right? Under 33, the SEC has the authority. Listen, the SEC is pretty much God, right? They're pretty much they and God. Can they issue stop orders regarding a new issue registration? They certainly can. If you say Roman numeral 2, again, flunk the entire test. Do you remember what the two nasty words we never use in the securities industry are?
Approve and guarantee.
Yeah, we never say anything's approved. We never say anything is guaranteed. So we need something without Roman numeral 2, which is helpful because that gives us a 50-50. Do they review standard registration forms? They do. Oh my God.
Well, 4's out for sure.
Yeah, my goodness. You know, you don't get many layups on the Series 7. You know, that's an easy layup. We should definitely have got that one right because we should have been able to eliminate 2 and 3 because both nasty words are used, right? We shouldn't say either one of those things. We never say anything's approved. We never say anything is guaranteed. So the answer is 1 and 3. Which of the following funds is most likely to contain within its portfolio those securities of issuers have not specified the use of the capital that they're raising? I like this one. This has been pretty testable recently because it was very popular, like most investment fads, and then kind of petered out, so to speak. And I would definitely know this one. So, income fund offered by an investment company. Now, in a regular mutual fund, we tell you what's in there. An exchange traded ETF, we tell you what's in there. Hedge fund containing, there we go, blank check. That's the key word. And blind pool offerings. Yeah, indeed, it is C. Do you know the other word we should be looking for besides blank check or blind pool? Do you guys know the acronym for those? Those are called SPACs. SPACs. Special Purpose Acquisition Corporations, where we go raise money in a public shell and then we find something to do with it, buy a business, an ongoing business. These typically have a public offering price of a blank check or SPAC of $10. So, we raised 10 million shares at 10, that's $100 million. We put it in an escrow account and we go try and find something to buy. The answer is C. By the way, the reason it's not the hedge fund that makes that the right answer. What makes that the right answer is containing blank check and blind pool. That is what makes that answer the correct answer. One of the advantages writing a call option covered by the shares of the underlying stock is, this is very much a test question. You could expect to get 3, 4, 5 questions on this strategy. This is called covered calls.
Mm-hmm.
Yeah. And why do we do covered calls?
Income. For income.
Generate additional income. Angels weep for you. If you miss that question, right? I don't know about you. When I take a test, I like to get to the first question I know the right answer to. Hopefully I'm not like 30 deep before something looks familiar, right? Good news, if you do all your Kaplan Q-Bank questions, that should happen pretty soon. The Kaplan Q-Bank is very reflective of what you're going to see on the actual exam. In social media, kind of weird, there's a guy who posted that he had been using reputable test prep vendors, more than one, and he'd been using free and paid supplements. And then he saw 20 questions he'd never seen covered in any of the material. You know, I got to call him out on that. I kind of did in a tactful way. Like, really? Come on. Which of the following activities are characteristics of a primary offering? So in a primary transaction, the issuer receives the proceeds. All those transactions together are called the primary market. In a secondary transaction, the previous owner receives the proceeds. All those together are called the secondary market. So this is asking us about the primary market. And so let's see what they want to know. Raising additional capital for the company, indeed. You know, that could be, we call that a follow-on offering. A lot of times when we're going public, we're going to do a shelf registration and to say we may come back later on and want to raise additional money. And so that is true. That is true. Selling previously issued securities. No, previously issued securities would be the secondary market. When we sell new securities that increase the number of shares outstanding, it certainly does, because outstanding shares are issued less treasury. And we just said we're issuing in the primary market more securities. So 3 is true. Buying previously, no. 1 and 3 is the primary market. 2 and 4 is the secondary market. Right. So I like that question. I like that question. You're correct. Looks like you guys are on a roll. In a scenario of falling interest rates. So as you know, I always tell people, you want to sound smart. Anybody ever asks you about economics, finance, or investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. People say, what about them? They say that they fluctuate. Is that good news or bad news? You say it depends. Now you can add, and I've been watching the yield curve. The yield curve. The yield curve is the difference between what short-term bonds pay and long-term bonds pay. Assuming all to be of equal face value, which of the following bonds would appreciate more? So this is basically the same question as what would lose the most, right?
So
And
since the longer term bonds
right
fluctuate more.
So that means it's either B or D.
Or D.
So now what say you, B or D?
What do you think, Ingrid?
I put it on my little chat. I think it's B.
You think
You
it's
are
B?
correct, right?
So how do you distinguish between the discount? What
Because the
makes that?
premium is already has a coupon that is higher than today's interest rates. So that already, to a certain extent, has been priced into that bond, and hence why it's trading at a premium. So D has a higher coupon. It's the opposite, right? We're asking about rates going up usually, and rates go up, we say long and low. So now we're saying the opposite, rates go down, again, long, and then we're going to be looking at the lowest price because it has more room to go up, appreciate. So that one's a little tough one. That's a tough one, but the answer is indeed the bond at a discount. Were you able to get it to a 50-50 at least, I hope?
I was, yes. I would
Good.
Definitely knew that it was the longer term bonds.
Yeah,
So
right. So selling at a discount. The
way
way I
my
would think
problem. I get 50-50 and then I'm like, whoa.
well, that's all right. That's, that's 50-50 is better than 1 and 4. For example, a 0 coupon bond would appreciate most. If I really think rates are going to come down, I would go for a 20-year 0, because that would really go rocketing up if interest rates came down. By the way, it also goes rocketing down if interest rates go up, right? So it's kind of the opposite. And so that's why it's that one. I think I would worry too much on the test about falling interest rates in this question. What I would worry about falling interest rates on the exam is when you have a declining interest rate environment, what you have is very testable call risk. Call risk is associated with the declining interest rate environment. It's very likely that the issuer is going to want to replace high cost debt with low cost debt. And then the follow-on test question is, what prevents the issuer from calling the bond? So if I have a bond in your portfolio, hopefully test question, it has call protection. Time and price, how long before the issuer can call the bond and at what price. So I think that's what you would see on the exam rather than this question number 9 here. The placement ratio in the bond buyer. I haven't had anybody in years tell me they've seen any questions on the actual exam about the placement ratio. But the placement ratio is published to the bond buyer, and it's the bonds sold by the bonds offered. And so this kind of tells us about the health of the muni market, right? And so here it says the placement ratio of the bond buyer indicates the relationship for a particular week between the number of bonds sold and the number of bonds. Well, I just kind of gave it away, did I not? Offered. Now, I think this one I wouldn't worry about as a test question, real test question. However, I would ask you this. So if we see the placement ratio is 90%, that means the syndicates that attempted to sell brand new bonds were able to sell 90% of them. What happened to the 10% of the bonds they didn't sell? Did those bonds go to bond heaven? Are they up there with the puppies? What happens to bonds that don't get sold in a syndicate offering?
It depends on if it's depends on what type of offering it is, right?
Well, it is, but
Western or
whether,
Eastern?
I like what you're on the right track, but whether it's Eastern undivided or Western divided, the liability will be different, but it goes into inventory.
Okay.
And we say, attention broker, blue light special, right? And then our brokers will sell those out of our inventory. I like your point
Okay.
though, because how many bonds we're at risk for as a syndicate member is very much dependent on whether it's Eastern undivided, because then our liability is based on our percentage participation. So I may end up with some bonds in inventory and will be based on that percentage. And if it's Western, the way I think of Western, I think what goes down stays down, right? Then my liability is set from the beginning when I say I'm going to take down X number of bonds. So I don't think here I worry too much about the placement ratio. I would definitely know the bond buyer is a newspaper. Now it's online, but widely read in the municipal market. And I wouldn't worry about the placement ratio. I wouldn't worry about the visible supply, but I would worry about what's called the notice of sale. So if we're doing a competitive bond underwriting, we're going to publish a notice of sale in the bond buyer. And that says, attention, investment bankers, we're looking to sell some bonds. And then various syndicates will be formed to bid on those bonds. So, if you're in the municipal business, you must subscribe to this thing because you need to know where the deals are, right? And this would tell you where the deal is. Notice of sale means it's not going to be a negotiated transaction. It's going to be competitive. Because if it was negotiated, we wouldn't publish the notice of sale. We would just sit down with our banker and figure this thing out, right?
I would have picked D too, Ingrid.
Let's see. Let's go back to D. What's the D choice? That's the visible supply. So D is if they would have said the visible supply in the bond buyer indicates, and it wouldn't be a week, it's published weekly, but it wouldn't be the number of bonds to be offered, not sold, just offered. And so that would be the visible supply.
Okay.
All right. So, by the way, that's what we're trying to do too. So if you want to talk about wrong answers, that's part of this process as well.
Oh, for
I
sure.
haven't seen either one. Let's give you a judgment question based on the visible supply. You notice the visible supply has been rising dramatically over the last several weeks. You notice the visible supply has been rising dramatically over the last several weeks. What does this say about issuers' expectations of interest rates? What does it say about issuers' expectations of interest rates?
Wouldn't they be?
Well, they're going down, they're going to stay the same, cannot be determined.
I would agree.
Yeah, you don't go to market with your bonds if you think rates are going lower. I locked it in by saying issuers' expectations. If you refinance your house, are you refinancing because you think rates are going lower? No, you're refinancing your house because you think rates are as low as they're going to go and they're going to start going up, right? The other way you could have done this is more supply means lower prices, and lower prices means higher yields, right? So I locked it in, by the way, by saying issuers' expectations. Issuers' expectations. That's a tough one.
Yeah, it is.
And again, I haven't had anybody tell me they've seen anything about visible supply or placement ratio, any of that stuff. I call them legacy Series 7 questions. They used to be there quite a bit. But the bond buyer's there. That notice of sale is certainly there as well. SEC regulations for securities issued by investment companies prohibit which of the following? Which of the following? Closed-end funds from issuing preferred stock. I kind of like this question. You should definitely know that closed-end funds are allowed to issue preferred stocks. They are allowed to issue debt securities. I didn't say own, I said issue. So I should know that one is indeed not true. Closed-end
So
funds
what's
are
the
not.
difference when you say own an issue?
Well, remember,
Not
if I'm an
understand.
open-end fund, I can own preferred stocks in my portfolio.
Uh-huh.
And if I'm an open-end fund, I can own bonds in my portfolio, but I can't issue bonds to get money to invest. Only money I have to invest is from selling or issuing common shares, my A shares or my B shares or my C shares. That's the only money. If I'm a closed-end fund, I can actually issue preferred stock, promise the preferred stockholders 6%, take the proceeds, make additional investments in my specialty. I could issue bonds, promise the bondholders 8%, take the proceeds, make additional investments within my specialty. So closed-end funds can issue preferred stock and bonds. Open-end funds cannot. The only money they have to manage comes from selling common shares. Now, remember, I said they can't issue preferred stock. They can't issue bonds. They can own them within their portfolios. They can own preferred stock from other issuers. They can own bonds from other issuers. They just can't issue them themselves. It is very, very testable to be able to distinguish on your exam closed-end funds from open-end funds. And I have a beautiful slide. I have a beautiful lecture. You can easily get 2, 3, 4 questions on the difference between closed-end funds and open-end funds. What is the biggest testable distinction? Do you know? Chat is open, or if you just want to talk, that's too cool too. Whatever speaks to you. What is the biggest testable distinction between open-end and closed-end funds? Open-end funds are continually offering new shares in the market.
Oh, right.
And closed-end funds, test question, trade supply and demand in the secondary market. So the biggest testable distinction is open-end funds trade in the primary market. You're doing business directly with the fund. By the way, that means primary market means there's a prospectus. And closed-end funds trade supply and demand. They trade like a stock. So the answer to this one, open-end funds are prohibited from issuing preferred, and open-end funds are prohibited from issuing bonds. And so the answer is 2 and 4, choice D. Last week, one of your customers placed a good till cancel order to sell 200 shares. Oh my God, these customers are such a pain. With an 18 stock. So he's saying, Dean, if the stock trades at or through 18, I want to sell it. When the stock is trading at 18.85. Now, I shouldn't have had to tell you that the stock is somewhere above 18 because it's very testable for you to know that a sell stop must be placed below the market. Now, here they confirm that indeed that is placed below the market. The X date, you should definitely know that on the X date, a couple of questions here. You should definitely know the X date is the first date on which the stock no longer trades with the dividend attached. You should definitely know that the stock should go down by the amount of the dividend. So now the question says it is now the X date. So we expect that that would go down 55 cents. And the order has not yet been executed. What happened to your customer's stop order? So unless the customer tells us DNR, do not reduce, we're going to adjust the orders below the market for that dividend. And so what we're going to do is take that $18 order and reduce it by 55 cents. And so what do you think the answer is this one?
So DNR, do not reduce.
Yeah, and there's nowhere in the question does it say that, right?
No.
Right, so you don't be bringing extra stuff into questions. If this said last week one of your customers placed a good till cancel order to sell 200 shares of ABC with an 18 stop D and R, then it would be A. because capital D, capital N, capital R means do not reduce. So that's where I say, I know that you're going to typically reduce this, but don't do it in my case, right? The stock, it didn't ask about the stock. We would expect the stock to be reduced to open up the next day at 55 cents less 18.85. Please note, it didn't ask us about the stock price. It asked us what's going to happen to this order, right? It's asking about this. It is not asking about that.
So they're just kind of throwing that in there for
Well, of course.
okay.
Of course, right?
So that wouldn't have even needed to be in there. Got
Yeah,
it.
yeah, as you know, right, ladies? RTFQ.
Yeah,
Read the full
course.
question, right?
I don't ever think that whenever you say that, read the full question doesn't pop into my
Well,
head.
listen, we
Something
have to
else.
listen, we have to be safe for work and home.
I know. I appreciate you for
Not
that.
everybody, Carol, is using headphones, and if you're
I
listening
know, right?
live, yeah, I can't be using my Marine Corps salty language because that would be a problem, right? We have
I
corporate,
agree, Ingrid. I think it's C
we
too.
got corporate trainers that refer people to my channels. I got to be a little careful about, which of the following securities can generate Fathom income? I kind of like this question. So Fathom income, let's just talk about that. It kind of sucks. It's paying taxes on money you're not actually receiving. That kind of sucks, paying taxes on money you're not actually receiving.
Oh, okay, that makes sense then.
Right. And there's certain investments we have where we're not receiving the money, but we still have to pay taxes on it.
Like zero
It
coupons, right?
sucks.
Right.
What's that?
Like zero coupons.
Exactly. Right. So we don't have a zero. I think the zero is actually the one you would see on the test. But
Okay.
the one we do have is this one's tough. This one's tough. I'll let you answer. What do you guys think the answer? What do you want to pick on this one?
I would say A.
It's not A because the T-bills mature in less than a year, and you would put that on your tax return.
Oh, so then it's C.
Well, there you go. It's tips, right? Because what's happening is every 6 months, the U.S. government is going to adjust the principal they owe you for CPI. So, for example, if CPI, Consumer Price Index, very testable, measured for inflation, is 8% on 1,000's $80, and they're going to do it semi-annually. So, in that first 6 months, my new principal value they owe me is 1,040, and then that $40 is going to be taxable to me as a Fathom income. So, I don't think you'll see that. I think what you will see, though, is the idea that you need to know that tips keep pace with inflation. I think you definitely need a Treasury inflation protected securities. I would have an understanding of that adjustment that's made semi-annually. And then I just want to offer to you a trick. They might say, like in my example, after 2 years, what is the value of the bond? And so rather than doing, the 1,000 times, 4% times 4% times 4% times 4%, if I get a question on a tip and it says, for example, a customer owns a Treasury inflation protected security tip. CPI was 8% over the last 2 years. What is the adjusted principal value? So what I would do is say, okay, let's assume it doesn't compound and it's not semi-annually. So I say, okay, well, 8% of 1,000 is $80, 2 years at $80. So I'm looking at something close to 1,160. And then what I would do is chop my answers and just pick the ones that's just over that, right? If you don't want to do the math. So, and maybe one will show up here and we can show it to you. The other thing is in the channel search bar, you can put tips and you can, you can watch me do this 2, 3, 4 times. So tips are going to be there. It's just not going to be that particular question. I think you got the question correct. Where it is going to be on the test is this idea of zero coupon bonds and doing the accretion and then owing taxes on that imputed interest you're receiving. A customer has a long margin account with a market value of 12 and a debit of 8. He has a special memorandum to his account of 2,000. How much can the customer withdraw from the account? So we say, So what are we going to do in this scenario?
The how much can they withdraw?
Yeah, I think I got to be a little careful
The,
because I would typically say $2,000.
right, that's what I would say too.
Yeah, but let's look
But
at
it
this.
seems too easy.
Well, anytime it seems too easy, it probably is.
Right, that's why I'm stopping
Don't get gun shy where you can't squeeze the trigger. But I
myself.
think it looks like to me that this is below 50%. Right? So I say, listen, here half of 12 is 6, and I only have 4. So I'm actually below 50%. So my account is restricted. I'm less than 50%. The second thing I'm going to look at is say, okay, well, 25% of 12, that's maintenance, and 25% of 12 is 3. And right now I have $4,000 in equity, and I certainly can't put myself into maintenance. I can put myself at maintenance. So this one, you're right. It was very, very tricky. And so what we did was we had to recognize that maintenance on it is 3. The customer has 4. So I say, sorry, you can only have 1,000 of your SMA as cash. And to be honest, outside of Series 7 Fantasyland, you wouldn't even be able to have that. But in Series 7 Fantasyland, you guys get to leave here someday. I'm stuck here permanently. No wonder I'm demented. Now, I would tell you, don't overdose on margin. I think this is a total waste of your time to try and turn yourself into a margin clerk. Let's just keep track of how many margin questions we got on the real test. Maybe we'll get 3 or 4. And I would suggest you could use your time better elsewhere. And what I would do on margin questions is probably just guess B, assign it to the universe, and move on. Now, the exception would be for things I know that are pretty easy, like the credit agreement, the loan consent form, the hypothecation form, the 2000. So I wouldn't burn up brain cells on that. Which of the following businesses must have more than one owner? This is kind of a stupid question.
Interesting.
Yeah, I think it's kind of stupid.
I have no idea.
Yeah, and I don't think you need to know that on the test either, to be honest with you. But we should know that LLCs can have one managing member. You know, we could have a C Corp where somebody owns 100% of the stock. We can have an S Corp where, you know, one person owns 100% of the stock, but we can't have a partnership without another what?
Partner.
Yeah,
Oh,
partnership. So I think that's kind of stupid.
good job, Ingrid.
Yeah. The thing I would know about partnerships is not here about they have to have more than one owner. All test prep vendors go way overkill on partnerships. But I would certainly know that partnership's going to have, for test purposes, a general partner and limited partners. And our clients are providing capital. They're the limited partners in a partnership. And then I would know a direct participation program has a flow through of income expenses. I don't know. We'll see what this draw is like. I did another draw like this yesterday in a tutoring session. Not everybody gives me permission to record and share. But in her case, oh my God, we got a draw where it had like, 10, really obtuse partnership questions. Like, God. And again, kind of like margin, I thought, what a waste. It's a waste because it's not on the test, maybe 2 or 3 like margin. So you want to, decide where to spend your time.
What about the oil and gas?
Well, I definitely know that as oil and gas programs go, exploratory is the most risky. Right, that's a wildcat program. You go where no cat's gone before, and you drill a hole. You either win big or lose big. We test you on losing big. I would definitely know that I might want to consider an oil and gas program if I have passive income, because in my my tax return, I can only use passive activity losses against passive income. And so, which partnership is most likely to provide that to me? It would be that exploratory program. And I would know that the partnerships, direct participation programs, there's 2, test question, that provide you with a credit, a dollar for dollar whack out of your tax bill. You know what those are? If we form a partnership for low income housing.
Of course. Okay.
Right. And what's the other one? Historic real estate. Historic real estate, right? George Washington slept here.
Mm-hmm.
So those are the 2 that provide us credits. So there's only going to be 2 or 3. I guess I'll just finish up my rant. So whether it's Kaplan, whether it's Past Perfect, whether it's STC, whether it's training consultants, all of them don't want to get rid of questions that used to be testable on partnerships. So in the old Series 7, there used to be 10, 12 questions on partnerships, and they were really tough. Now maybe 2 or 3. But, the thing yesterday was aggravating me is we kept getting questions about, recourse notes and non-recourse notes and how that affects your cost basis. And oh my God, and how a mortgage does, and a mortgage, no mortgage doesn't. And I just think it's a total waste in terms of basically does. All the following statements regarding commercial paper are correct, except. Now, I would definitely know that commercial paper is a money market instrument. I would definitely know it's issued at a discount. I would definitely know it has a max maturity of 270 days. And I would know other money market instruments as well. It's quoted on a discount yield basis. It's quoted as a percentage of par. It's unsecured. And remember, it's asking me except interest is received at maturity. What do you say on this one?
I would think that one's the wrong one.
B?
Yeah, it is B, right? It's not quoted as a percentage of par. It's quoted on discount yield. I say, if you pay this price, this discounted price, this is what this yield will be to you. So it is not quoted as a percentage of par. Bonds are quoted as a percentage of par, but this is not a bond. This is commercial paper. What's another money market instrument that you need to be aware of besides commercial paper?
Banker's acceptance.
Right on. They love to test you on banker's acceptances. Same thing. Issued a discount, 270-day max maturity, and test question, what are bankers' acceptances used for? What are bankers' acceptances used for?
Something I would know it if I saw it in a test question.
Well, I agree with you, Carol. I'm being a
I
jerk.
mean,
I'm asking you to pick them out of the stratosphere.
Yeah.
You would have an answer said, they're used to facilitate foreign trade.
right.
Yes.
Right?
That too.
I was like, wait, I know that.
Yeah.
I was figure. I was like, wait.
Okay, one more. So so far we got commercial paper, we got bankers' acceptances. So what else we got is money market instruments.
The
Negotiable jumbo CDs.
oh yeah.
Negotiable jumbo CDs. And then the last one we have, and there's nothing better than this. This is the best money market instrument available. T-bills.
Oh.
Right? T-bills. Nothing better than a T-bill because it has the full faith and credit of the United States Treasury.
Not very good at finishing your thoughts.
TANs, RANs, GANs, and BANs. Okay, so I think this is kind of like the muni equivalent of borrowing against receivables. I kind of think of this as like a payday loan for municipality where they're expecting to have some monies, but they kind of want to get the money now, like a cash advance. So TANs are tax anticipation notes. RANs are revenue anticipation notes. GANs are grant anticipation notes, and BANs are bond anticipation notes. And so I kind of gave it away. The answer to this is indeed A. That is a give me on the test. That is testable. That is testable. They have their own unique credit rating. Do any of you know the unique credit rating that would be assigned to municipal notes? They have what are called MIG ratings.
Yeah.
MIG ratings. MIG 1 is better than MIG 2, which is better than MIG 3. That stands for Moody's Investment Grade. Oh man, what a mess. I think this is outrageous.
Okay.
I think this is outrageous. But that being said, there's lots of ways to do math. So a 50,000 20-year 7% muni bond with semi-annual March and September coupon payments is issued on March 1st. So March 1st is what we call the dated date, the date it starts to accrue interest. The full price for a trade. So I should know that a buyer of a bond not only has to pay the full price, which includes the price of the bonds, but actually the calculation of accrued interest. So this person is going to owe not only the price, now, by the way, it says issued, and bonds are issued at par. So the customer owes $50,000 plus the accrued interest from March 1st up to, but not including June 30th. Right? So there's what we have to first do is calculate the number of days of accrued interest. Now, do you ladies use the long method or do you use the shortcut?
I use the long method just because it's the only way that makes sense to me.
Okay,
and
so
right.
if you're using the long method, please apply that now.
What about you, Ingrid?
I used the long method.
Okay, I, no surprise, use the shortcut. So I like to take the settlement, 6/30, June 30th, and then I like to subtract the last time the bonds are the last when it accrues interest, which in this case is 3/1. And you guys are still doing your long method. I told you go ahead and do your long method. And Dean will wait on you. Because Dean is already done. I've got 29 days using my shortcut there. And here I have 3 months. And every month has what?
30 days.
30 days. That's very decimal. So 90 days here. So I have the first part of the puzzle, which is 119 days of accrued interest.
Okay, got the same.
Now, if you're using the long method, you should have 30 for March, 30 for April, 30 for May, and 29 for June. Okay, so the next thing we got to do is we got to figure out what is the interest per day. Math, there's a lot of ways to go, but I like to use interest per day. And then whatever I find that is, I'm going to multiply it by 119. So the next thing I'm going to do is I'm going to take $50,000. Or I probably could do it per bond. Maybe that's a little easier. So I'll take one bond. And I'm going to times it by 7%. And I find out that each of these bonds pays $70 in annual interest. And so now I say, well, how many bonds do I have? And I have how many bonds here? 50,000 is 50 bonds, right? So I have 50 bonds paying $70. And so this is what I'm going to be getting each year from this investment. So 50 times 70 is $3,500. And then again, there's a lot of ways to do this. What I like to do is I then like to divide that. And I'm going to divide it by the year. Am I going to divide by 365? Or am I going to divide by 360?
60.
Right on, because remember, under the Uniform Practice Code. And when I do that math, what I get is what's called interest per day. Right? And I need to find out interest per day. So now I take my calculator and I take 3,500, divide by 180, and I find out the interest per day is $19.
No, by 360, not 180.
No, not, I'm doing 360. I'm taking, you can do 180, but 180 would be half.
No, you just did 180.
Oh, I did. Oh, thank you for
Yes.
correcting.
Yeah,
I did that on purpose just to see if you
I
were.
know you did.
just to see if we're paying attention.
Thank you. I appreciate
I
it.
was like, what's going on? I had to look at it.
Wait, you lost us.
Yeah, well, yeah, do as I say, not as I do, right? So, chance to redeem myself here. So I get $9.72 in interest per day. And then rounding should make a difference, but that's actually 972.2222. That should make a difference in my answer. In other words, there's only going to be one that's going to be close. So my point is, if I don't want to burn up brain cells, I could just use 972. I'm almost done. So now I'm going to take the 119. I'm going to times that by $9.72. And that will tell me how much the buyer owes the syndicate The syndicate is the seller, in accrued interest. And let's see when I do that. 119 days up at 972 per day, or 9.722. And I get $1,156.92. And so again, it looks like I'm going to have 50,000 plus that. And so it looks like our answer is choice C. A lot of work for 1 point. I don't think you're going to have to do that on the test. I don't think you're going to have to do that on the test. I think you definitely should be prepared to do number of days. So what I mean by that is I would definitely be able to come up with this 119 days. Whether you do it, the long way or the shortcut, that is definitely something I'd be prepared to do. Right? By way of review, a lot of work for one question, but we say, okay, so how are we going to go about this? We just say, well, we got to figure out the number of days of accrued interest. Boom. Then we got to figure out, by the way, I could have done 180, but then I would have taken half of the 3,500 because that would have been the 6-month time frame. But I like to do as least amount of math as possible. So, any step I can skip, I just skip it. Anyway, so here it's $70 in annual interest. We have 50 bonds. That's where I got the 3,500. I divide by 360, 972. 119 is 1,156.92, 94, just as the rounding, right? And that's the answer. Any questions on that one? That one's a tough one. I don't think I would have actually, as Dean was taking the test, you're not me, but if it was me, I would know that I'm going to get enough right to pass. So I would have just assigned this one to the universe. I would just say, this is too much work. I'm going to make it up elsewhere.
Not me. These math questions I rely on because I feel like math is
Well, that's true.
like it's for sure. So
well, Carol, I got to tell you that the 3 styles of questions are recognition, practical application, and judgment. And I do tell people, even if they're terrible at arithmetic or it's not something they enjoy, like Dean, you can't be giving up practical application question, because with a math question, there's no interpretation about the answer. You just simply get it right or you get it wrong. And judgment questions, it's very easy to get a 50-50 and miss it. So I'm with you on that part of it, certainly. All right, let's move on. By the way, the other thing I get aggravated with, Carol, is when people have a time constraint on the actual exam, because we chewed up a lot of time on that particular question. But the reason I get aggravated, because that means people haven't done a practice test to see how long it takes them to work their way through 125 performance opportunities, right? And if you're having a time constraint, and unfortunately you can't leave this and come back to it unless you answer it, right? So if this was a written test, I would say, hey, let's just leave that blank and come back to it. But here it won't queue up question 19 until we answer question 18. And because of that, I suggest we deal with it as it comes rather than trying to circle back on it. All right, under what circumstance would a fiduciary of a qualified corporate retirement plan be permitted to write covered calls on the portfolio? I like this question.
If the strategy is consistent with the objective of the plan.
Right on, right on. Suitability, right? Yeah, I like that one. Which of the following investors would be exempt from filing 144? So I would probably, before I answer, say, oh, okay, 144, isn't that about like control persons and volume limitations and things like that? So the other thing I like to do is kind of think about my what I call the Sesame Street trick. So whenever they tell me which of the following investors, what they're actually saying is one of these investors is not like the others, right? So which one of these is not like the others? Now, one of these is somewhat different than the others.
Is it? I don't want to say, Ingrid, if you're not ready. So
you can go ahead. I kind of read a little slow and then I have to think.
No, go ahead. I'm not gonna. Let me know when you're ready.
Okay, go ahead, Carol.
I think it's B.
Yeah, it's not B as in boy, because let's talk about the Sesame Street trick.
Okay.
Unregistered shares. That means shares you did not get in a public marketplace. Unregistered shares. And in Reg D, what kind of securities do you get? Unregistered.
Unregistered. Okay, so I had it flip-flop. Dadgum.
And then here it says an employee selling registered shares. That means they got them and then it tells you, by the way, that they got it in the secondary market.
Okay.
And by the way, it's not a control person. This is not an officer, not a director, not a principal stockholder. Right. So it's A. And then the thing that made C kind of tricky is you should know that when you participate in a private placement, that you are receiving unregistered shares that never went through the process of 33. And then the registered means they have gone through that process. Right. So this answer is going to be A.
Okay. Ingrid, that's what you had, huh?
Yeah, that's what I thought, but then I got so confused. I was like,
Oh, so you're looking for those pivot words. So the pivot word is this word here, right? A bonus question. So how long do you have to own unregistered shares?
90 days.
And
6 months.
Oh, 6 months.
Yeah, the form is good for 90 days. Different question, right?
Yeah.
The 144 is?
Yeah.
File that form.
So you know why I answered like that? Because I just looked at 144 and I'm thinking, oh, 90 days.
No, I'm with you. I'm with you. So RTFQ again, right? Make sure you're clear.
Interpret it how you want it.
Oh, God.
An investor opens a short position in one XYZ November 140 put at 7, disregarding any commissions. If the option is exercised on settlement date, the investor, so I like this one. Assuming you're using the matrix, I would go to my quadrant for short put. And I would say, okay, when I'm short a put, I have an obligation to buy the stock at the strike price. And so what I have an obligation to do is buy 100 shares at
1,400.
140. If I didn't want to do that, I shouldn't have, done this trade, right?
So then he has to pay.
That's right. Now, remember, they didn't ask me the gain or loss or anything, right? They're just asking what happens if you are short a put and you get exercised. You're the put E. If there's going to be put-ers, there's got to be put-es, right? Now, we don't know if this is good news or bad news because we don't know what the stock's at, right? So, this isn't about gain or loss or break even. It's just, what are you going to have to pay? You're going to have to pay $14,000. Just for fun, though, what is the break even? I didn't ask that, but what if we would have asked you the break even here? What would it be?
133.
Excellent. Are you a bull or a bear?
I am a bull.
Excellent. Excellent. What's your max gain?
My max gain is 7.
The premium.
Yeah. You agree to be a potential victim. Nobody victimizes you. Neener. Right? 140 or higher. There's a ceiling of 140. 140 or higher at expiration, the contract expires. What's the maximum loss? Somebody makes you pay 14 grand for worthless stock. You keep the 700. So the worst case is you're going to lose 13.3.
Yep.
Investor has a diversified portfolio of common stock with a market value of 1.7 and a beta of 1.2. So this stock is more volatile than the market. And so that means I'm going to have to overweight it in terms of the hedge. And again, this is one I think you probably should just assign to the universe and make it up elsewhere. But, it says quoted at 680 to protect the portfolio against a decline in value. The investor's best strategy is, now I think you should have been able to get this pretty quickly to either A or B, right? Because you should know that the best protection against a portfolio as it relates to systematic risk is buying a put. So are we clear? We should have been able to get this to a 50-50 pretty quickly.
Yes.
Yeah, because
and then what I would have done, again, I'm lazy. I wouldn't try and do this math. It's a total waste of your time. But what we need to figure out is like the market value, the 680 divided by 1.7 times 1.2. But I would have just in my own mindset, I got to overweight it. So I'm going to go for the 30 puts just because that would overweight it. I wouldn't worry about doing the math here. You know what I
But
would
how
do?
would you do the math? Do
If
it
I was going to
again?
do the math, I
Say
would
it
take the
again.
1.7 and I would divide it by 68,000 because it says that's quoted. That's what that contract is. So I take the 1.7. I would then I'd say, okay, I divide that. I find out that's 25 contracts, and then I times that by 1.2, and I come up with the 30. But again, I think that's a total waste of your time.
Oh, you have to times it by the beta.
That's
Wow.
right.
Okay, that's a
Yeah, you got to overweight it, right?
wow.
By the way, if you get this, it wouldn't be this beta here. It would be expected return. They'd say it would be an individual stock. It wouldn't be a hedge on a beta. It would just be the market is 10%, the beta is 1.5. What's the expected return? You tell me 15%. Right. And then the excess would be alpha. So this would not be in the context of a non-equity option. A client enters a buy stop. Oh, I like this. Very testable. So we should stop and say, okay, buy stops have to be placed above the current market price. And I'm telling my broker, if it trades at or through 40, pull the trigger. Pull the trigger, turn it into a live market order. A live market order. The following trades then occur. I like this. This is a good test question. 38. Anything happen at 38?
No.
No.
No. Anything happen at 39?
No.
No. We're looking for a trade at or through. Anything happen at 39.90?
No.
No.
Anything happen at 40.05?
The
Yeah.
trigger.
Ding, 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 ding. On a number line, there's no way to go from 39.90 to 40.05 without trading through 40. Two separate events. Two separate events. Guys get confused about this. Oh, that's my trade. I go, no, that is not your trade. That is the trade that turned your suspended contingent order into a live order. And now you said you want immediate execution at the best available price. Right? So I said buy stop order for 100 shares. Oh, at 40. My bad. He has specified his price. And he says he wants to buy it at 40 or less. So he will not accept that 40.10 because now he said that he wants his price or better. Now, I think that's kind of silly, but customers can be as silly as they'd like to because now he's saying, as a buyer, he wants his price or less, right? So we got to figure out buy stop 400 shares at 40. Nope, it doesn't say limit in here. It does not say limit anywhere in here. And so this is just going to be turned into a market order. So the answer is going to be, what say you? I say 40.10. We may miss that one, but I'm going to say 40.10 and not 39.78 because it is not a limit. It would say, if it was a limit, it'd say buy stop limit for 100 at 40. Any question on that one? That's a very good
I would
test
have
question.
put the same. I would have put B too.
I would have put that too. 40-10.
Yeah, I think we're going to get that right. I'm pretty sure we got it right. Customer has 15,000 of equity in a margin account. Kaplan. Sometimes Kaplans are just such jerks. You're like, oh my God. So what is this? I told you we keep track of how many margin questions we got. I think it's our second one, right? And we haven't got any of the straightforward kind of aim and shoot, point and click questions. I think what I would know is the classical margin equation, which is long market value minus debit equals equity. So they're telling me here that we have equity of 15,000, and that represents 30% of the market value. And so the way I would do this is I would take do you remember like middle school algebra? I don't think you need it for this stuff, but the way I'm going to do that is I'm going to take the 15,000 and I'm going to divide that by 0.30. And that would give me, I think this is a total waste of your time. Don't think you're going to see this on the test. At 15,000 divided by 0.30, I get 50,000, $35,000, right? So I'm taking 15,000, I'm dividing by 0.30. I'm getting something here, divide 15. Oh, that's the market value. So I get the market value of 50,000 And then what I can do is I can check it. You know, what I'm doing here is I'm just checking it. I'm saying, okay, well, let's see. What is the debit balance? So if I figure out the market value is 50, and boom, the debit is, that's given information. It said, well, it tells me this is this.
Shouldn't you? I'm confused.
Yeah,
How
hold on
is-
just a second. Just a
Okay.
second. Right. So there's the equity. And here it says, what is the debit balance? So if that's the case, that would have to be 35,000 and debit. All right. So here's how I did this. It said a customer has $15,000 of equity in a margin account. This represents 30% of the market value. So what I have to do is I have to establish what is the market value. And so the way I'm going to do that, remember the solving for the missing information, is I'm going to take the 15,000 and say, okay, let me divide that by 0.30. Because if that would be the number that 30% is, right? If I can check this, by the way, by just saying times 30%.
But
Indeed,
wouldn't only 30% of 15?
it's 30% because that's given. It's given information.
I know, I get that, but wouldn't it be less if it's only 15%? Wouldn't it be 4,500?
I'm not sure what you're talking about, 15%. There's no 15%.
I mean, no, 15,000, I'm sorry.
15,000 is what they're telling us the equity is. They're saying that when we take the market value minus the debit, it's 15,000. That's what equity is. The classical margin equation is long market value minus debit equals equity. And they're saying that if we took the long market value, we should know this, long market value minus debit equals equity. So some number, long market value minus another number equals 15,000. So what we have to do is find that number. By the way, I could have done this by process of elimination. I could have also just plugged in whatever they're offering me as debit balances here, right? I could say, well, let me check this. It says the debit balance is, and if I plug in 35,000, again, knowing my classical margin equation, I would know that that's got to be 50. So this is an algebra question. You won't have to do any algebra question. But what I did here, there's always lots of ways to do math. What I did here was I said, okay, well, I got to figure out I got one of these numbers. The number that's given in the question is the equity. So, you know, remember this from grade school? I mean, I'm having flashbacks.
Because what you're saying is you can multiply the 15,000 twice.
That's right. That's right. And then, you know, what I'm doing is I'm solving, you know, they're saying X minus Y equals $15,000, right? And so they're asking me to figure out what Y is. I'm solving for the debit register. And so I'm saying, okay, well, I got to know what the long market value is. I got to get a second number here. And so what I did was I said, okay, well, let me figure out what would be the market value. If 15,000 is 30% of that number, they're saying that this 15,000 is 30% of the long market value. So what I did was take the 15,000, I divided by that to find out the long market value. And then once I did that, I'm back in business. But what did Dean tell you about margin questions?
Right.
What did I tell you about
I
margin?
got A on it because I
It's not A.
times.
It's not A. It's not A.
I know, I believe you about obviously, but I did it wrong. I
Well-
did 15,000 times 30%.
No. But
Right.
listen, ladies, what did I tell you about margin questions?
To keep going.
Don't overdose.
Don't overdo it.
I said guess B, assign it to the universe,
Oh, look at that.
and
just
move on.
keep it going.
Right? That's what I said. I think I've said that, right?
That is what you said.
That is totally what you said.
That's so funny.
By the way, you don't tell anybody because I'll get in trouble. But the reason I tell people to guess B is there is some logic. I suggest learning the information. But when all else fails, I take heat for talking about test taking tricks and tips and tricks. But I used to teach a weekend class We're the cream de la cream of American financial educational establishments. I mean, these are men and women from Wharton and Stanford and Harvard. And anyways, I came back from break. I heard one of the guys telling somebody else to guess B. And I teased him unmercifully. I said, that's what we spent. What did we spend on your education? $100,000, and you learned to guess B. And my problem is I don't know when it's no longer funny. I keep teasing. And anyways, I could tell I kind of irritate him at the end of the day. To get their attention, I give them homework. And he came back the next morning and threw my own answer key at me because I don't give him the answer key to get their attention. He goes, Dean, 40% of your own answers are B. I said, ooh, I could tell he was irritated. He said, Dean, you know, we did a survey of cram courses and test writers, and most people are told to guess C, as in Charlie. And test writers know that. And they statistically shy away from C. And so C used to be your best guess. Now it is B, as in boy, is your best guess. Now, I am not saying that you can pass the Series 7 by guessing B. I'm just saying that when I have no clue and I've exhausted every other trick in my book, then I'm going to do what?
Guess B.
I'm going to guess B, I'm going to assign it to the universe, and I'm going to make it up elsewhere.
Keep going.
One of your customers, age 52, wishes to open an IRA. His annual income is $200,000 and consists entirely of income from rental real estate and income from a trust fund. What amount can your customer contribute to an IRA? Yeah, you ladies are correct. I like this question. It's got to be earned income.
Correct.
It can't be money working for you. It's got to be you working for your money.
But even then, wouldn't the 200,000 be over the?
Well, yeah, I mean, he would have a means testing too, but you know, the main point here is again, you have to have earned income.
Okay.
And your trust fund is portfolio income. The one they like on the test, by the way, on the test, it won't be rental real estate. It won't be income from a trust fund. It'll be dividends.
Okay.
They'll say your customer has dividends, has, $30,000 in dividend income. Can he fund the IRA using the dividend income? And we would say no. When a member firm receives a written complaint against one of its representatives, the person first informed about that complaint is. So there's no distinction, by the way, if it's a text is still a written complaint, right? So don't fall for tricks where you go, oh, I don't know if that's a written complaint or not.
The designated principal.
Yeah, see.
That's right. Yeah, it's the designated principal, right on. Right. The person first informed, and the rep can't handle their own thing. An investor with a well-diversified portfolio oriented toward growth has 60% invested in stocks of 28 different companies. Oh my God. That kind of sounds like diversification. Crazy. She would like to hedge the downside risk of her equities and is comfortable using options to do so. Which of the following would be most suitable? I kind of like this. So she's not worried about a particular stock in her portfolio going down. She's not worried about selection risk.
So would it be B?
You're right on, right? I'm sorry, did you say B as in boy?
Yeah.
No, because remember, whenever we say protection or hedge, you're not going to sell an option.
That's right. That's right.
You're going to buy it. That's right. You're going to buy insurance, right?
Yep.
You're going to buy insurance. And again, so you should have immediately kind of gone to purchasing puts.
Index. Yep. A purchasing
There
entity.
you go, right? That's I like that. Very much a test question. This is way more likely than the one we had previously where you had to overweight the thing by the beta 1.2. This is pretty straightforward. It is testable. This would, by the way, be churning. I call you and I say, what are you doing? And you say, well, Dean, I make more money buying puts on each of your individual stocks. I go, that's a bad answer, right? You should do index puts if she's worried about systematic risk. Badentown is planning to raise money in 3 months to build a new city hall. The mayor wishes to start groundwork preparation immediately. I like this. This is a good test question. How could the money be raised to fund the work? Yeah, the key, by the way, is they're planning to raise money. They're planning to raise money. That means they're planning on selling some bonds. And And so what say you? Boom, right? You get that from your underwriter. That's very testable. I say to my underwriter, hey, you're going to be raising money for me in 3 months, but I'd like to get going. Can I have a bond anticipation note? I'll give you a bond anticipation note, underwriter. You give me some money, we'll get rolling. Then when you sell the bonds, I'll give you back your money and a little extra.
Oh, because it's a short-term note that
That's right.
I got it. Okay.
Yeah, I like that one. Pretty testable.
Yeah.
I guess a good miss would be B, but it's still a miss. My construction loan note is to, finance construction. But here it says I'm raising money in ground preparation, right? So, you will get a question about a ban. They are on the test. If a confirming broker dealer receives a DK notice, that's a don't know. I mean, DK means don't know. So I'm the other side of the trade, and I say, I don't recognize this trade. I mean, you're telling me that I bought 500 shares of XYZ, but I don't see that on my blotter anywhere. So I'm sorry, I'm going to have to DK. So a DK means don't know. And then what we're trying to do is fix it. Well, I think I gave this one away now that I told you DK means don't know. Doesn't it know he still wants the security? No. Meant to say okay, but in the wrong. No. Has no knowledge of the trade. There we go. Ding. Right.
Yep.
Yeah, I don't know if I don't. I think this is more back office stuff than Series 7 stuff. This one. Covered call writing normally occurs. Well, I kind of disagree with these kind of questions because I'm not sure that, that you can make an argument one way or another about what market would you do covered calls in. You're doing it to generate additional income. I think a better phraseology would be, when is a covered call the most efficient? Covered calls are most efficient, not when the market is going way up because you get called away on the stock, right?
It would be a stable market?
Yeah. I don't like the actual question itself because I don't like the normally thing. I take exception to the phraseology, but I would prefer this said, covered call does best in which of the following markets? Right. And that's how I would have phrased that question. Your customer with a discretionary account is approved to trade all options, strategies, and positions. Woohoo! Master of disaster. Regarding discretion, the customer cautions that no positions having an unlimited loss should ever be used or would be acceptable. I like this question. Which of the following options would still be suitable and therefore employed in the customer's discretionary account? I like this. On a question like this, I want to get real comfortable before I answer. And so I just want to kind of put this in plain English for myself. And what they're asking me is to identify strategies in which there is limited risk. Limited risk. So in choice A, we have long calls and puts, short straddles. Does a short straddle have limited risk?
It has unlimited.
So that's out, right? Process of elimination. Long and short straddles, short calls and puts. Do short calls have limited risk?
No.
So B is out. B is out. Long calls and puts, long straddles, and long and short spreads. A credit spread. Does a credit spread, a short spread, have limited risk?
It does because it's within the market. Like if it stays.
Man, perfect.
Right.
Perfect. You're turning me on as a tutor. That's absolutely right. That's the whole thing about a spread. You're saying you only want to play between the strikes.
Right.
There's a floor and a ceiling. That was an excellent explanation. And that means we have found the answer because none of those expose you to unlimited risk. How about D? Short spreads don't, but short straddles do. I like that question.
Yeah.
I kind of walked you through that. It looks like you guys did pretty good on that one. I like that one. That was a good question.
Dean, if they give us all math and options, we're good to go.
That's a good thing because you're going to get 20 option questions. So I like it. I like it. Now, I think there's more than some people. You got to be careful because, as much as I love Brian, my brother from another mother, he thinks there's like 10 option questions. I think it's 20, give or take 5. I think you could get 10. I don't know. You could get as high as 30. But in any circumstances, I would want you to be prepared for options because if not, then it becomes a, kind of a handicap. So I like to hear that you're ready to give me 125 options. Love it. Love it. Which of the following best describes the advantage of oil and gas income program? So we're buying proven producing reserves. Proven producing reserves. So why would you buy proven producing reserves? What is the biggest advantage of that?
So it's low risk, right?
Yeah, it's compared to other oil and gas, right? So, right, depletion allowance is certainly true. You do get that. Best describes advantages of it. You do have depletion allowance. I don't know how much oil's down there, but I know if I pump and sell a barrel, I got 1 barrel less. So A is not true. We do get depletion allowances. It doesn't give us the highest tax write-off because it's less risky. It doesn't have the greatest risk. That would be exploratory. So, by the way, test taking trick. Have I shared with you this test taking trick? The answer has to be C or D. And the reason it has to be C or D is because if you are a good test taker and you answer A, that's bad form. Because you can't leave two things that are exact opposites in the answer set. Right? Because now you have a conflicting answer. It can't be greatest and lowest in the same. It's one or the other. I call that the principle of mutual exclusion. Right? And the one I always use with people is Socrates is a dog. Socrates is a philosopher. Are we clear? He's either a dog or a philosopher because he can't be what?
Both.
Yeah, he's one or the other, right? So
Yep.
Anytime you get a question where you got two opposite answers, the answer is one of them. In other words, what I'm saying is you can, as a test taker, you can blow off A and B. You can just say, well, it can't be one of those because I got to deal with C and D because they're opposites. So I can get to a 50-50. An individual purchases a single premium deferred variable annuity. There will be tax ramifications in all the following circumstances, except there will be tax ramifications in all the following except.
Okay.
B.
Yeah, it's B. Remember, it's going tax deferred.
Oh, that's right.
It's going tax deferred. Right? Any question on that one? I don't like the phraseology, but you should know that it is growing tax deferred. You should know it has a cost basis. You should know that when you annuitize, turn into an income stream, life only gives the greatest payment, monthly payment. Right? So you're going to get a handful of questions on annuities. A customer purchases, I like this one, a 6% bond in the secondary market on a 7% basis. The effective after-tax yield is. What say you on this one? This one's kind of interesting.
Wouldn't it be between 6 and 7?
Excellent. And how did you do that, Ingrid? You are correct.
Because your year to maturity is 7%, so it can't be above 7%.
Excellent. So you were able to reverse engineer that this is a discount.
Mm-hmm.
I see.
And
I
that
see.
part, discount to par, is taxable. Right? You're going to owe taxes on that. You don't owe taxes on the 6. And you're not going to get to keep the entire 7 because that difference is taxable. So excellent. Excellent. That teeter-totter is worth some points. So that was a good get. When customers receive their account statements, they will generally not include. So what is not on your statement? This one's kind of stupid. Yeah, you guys are right. You said C. Good job.
Oh, haven't
I think
seen-
this is kind of stupid as a question. What I would know very testable is how often must I give you statements?
Quarterly,
Unless there's a penny stock, in which case.
monthly.
And if I ask you to hold statements, can you hold my statements for me?
Yes.
If you write,
If
it
you're
has to
in
be written instructions.
That's right. And can I ask you to extend that period of holding my statements?
Yes. You
It can't be
but
convenience, right? It's got to be security. So I think I don't really like this question in terms of what it tests on because, you know, I don't like that, you know, we're telling you to distinguish this. I would just know the frequency of statements. All the following pieces of information must be obtained by in new individual customers except. So what do we not need to open the new account? What do we not need?
B.
Yeah, you know, it's, you know, we don't need to know whether you went to college or, you know, who cares? We definitely need to know your date of birth because we don't open accounts for minors directly. We definitely need a physical address. Physical address will send things to a P.O. box. But, you know, on the original hard card documentation, we need a physical address and we need a tax ID number. Very testable on an UPM account whose tax ID number goes on the account, the custodian or the minor.
Or the minor.
Very, very testable, right? Oh, all righty. So, you know, let's have some fun. This is an advanced option strategy. This is a multiple option strategy. Let's test your prowess. You know, you were just let's see if you had some hubris. I think one of you ladies said, I want 125 option questions. Well, here you go.
She's good at them.
It's 1 and 4 stay.
So what we should do, I think first thing I want you to be able to do as a test taker is identify this as either a spread or a straddle. This is a straddle because we're short two different type of options. And then the second test question, once we've identified it as a straddle, is to calculate the break-evens. And the way we're going to do that is we're going to combine the premiums. We're going to combine the premiums.
35.
And we're going to add it to the call and subtract it from the put. Now I'm putting that in green because this is money in. That's a little too. Let's get a little boom. So now I'm going to take 30 plus 435. And I get my upside break even of 34.35, which is Roman numeral 4. And then I'm going to take 30 minus 435. And I'm not being facetious, ladies. I'm terrible at arithmetic. So if they give me a calculator, I'm going to say thank you very much. 30 minus 4.35. And I get 25.65. And then what I like to do is then look at my answer set and see if that answer is available to me. Because if not, that means I blew it, right? Go back to the drawing board, right? Don't raise your hand at the site and say, hey, I think I found a typo, you know? Right, so there we go. So now I have the answer. The other thing I should know, test question number 3 about a straddle. It's 1 and 4 is when do we use it? So here we're expecting the stock to stay within this trading range. And we do have a mnemonic device for profitability in straddles, a memory aid device. Do you know the memory aid device for profitability in straddles? Silo. Silo. That stands for short inside, long outside. So this will be profitable as long as DWQ is between 34.35 and 25.75. And ladies, please note, it doesn't matter you have 2 or 3 or 4 of them, doesn't matter. Break even is always expressed on a per share basis. Yeah, any questions on that one?
No.
Did you guys get it?
Yes.
Awesome.
too.
Awesome. Smith and Company, a FINRA member firm, is preparing to underwrite securities to be issued by KLC Corporation for a new business venture. For which of the following will Smith and Company be responsible? So we're asking here, what is the investment banker Smith and Company responsible for? You know, let's see. So do they file the registration statement of the SEC and state regulatory bodies?
Yes.
Yes.
No, they don't do that. The issuer does that,
Oh, dang.
right? The issuer does that. Do we provide the advice to a KLC about the type of security they might want to issue, common, preferred, secured
Yes.
bond, unsecured bond? Do we do that?
Yes, that's why they hire them for
That's
the
exactly what it
advice.
is, right? That's exactly right. And then do we help them sell those securities to the public?
No, oh, wait, yes.
So yeah, remember they hire us to do 2 and 3.
Okay.
And then do we give them advice on how they use the funds? No, we don't typically do that. I mean, that's up to them. I mean, if they want, I guess we could help them do that. But 2 and 3 is our function as an investment banker, is to provide advice on the type of security, common, preferred, bond, whatever, and then sell the security to the public. By the way, we got to be real careful here. The biggest sin you can commit in our business is making a fraudulent distribution of securities to the public. You have to try really hard to go to jail in our business. I mean, if you go to jail, it's tough, but if you do, it's probably for this, making a fraudulent distribution of securities to the public. And we're on the front page of every prospectus. What does the front page of every prospectus say? In big, all cap letters, the SEC neither passes upon the adequacy or the accuracy of the information contained herein. They neither approve nor disapproves of any securities offered. The last sentence is what we care about. Any claim to the contrary is a criminal offense. Go to Club Fed and make some new friends. And so the answer is 2 and 3. Oh, I like this one. Now, this is, I think, a good counter to the one we did last time, right? The last one, we decided that it was a straight sell stop because it didn't have a limit in it. And so we said that we were going to pull the trigger. It'd be immediate execution at the best available price. And so we said that they would accept 40.10. Now the customer is saying, Dean, if the stock trades at or through 42.40, pull the trigger, but don't make it a market order, make it a limit order. And what I want to do is sell, but only if I can get 42.15 or more. So now we got to be a little more careful going through this sequence. The following trades then occur. So the sell stop, whether it's a market order or becomes a limit order, slobs over bliss. Sell stops are placed below the market. So there's our first trade. Nothing happens there. Everybody agree nothing happened at 42.45?
Correct.
Yes.
Boom. 42.40 at or through.
Yes.
So now it becomes a live limit order.
Mm-hmm.
So, 2 separate events. Customer get confused about all that. That's my trade. I go, it's not your trade. That's the trade that turned your suspended contingent order into a live limit order. And now we got to be careful, because now the client has said he will accept as a seller 42.15 or more.
Mm-hmm.
All right. So let's see. Our next trade is 42.75. He'll accept that.
Mm-hmm.
Yes.
42.27, he would accept that.
Yes.
41.91, he would not accept that.
Right.
So which of the following prices could this order be executed? It looks like we said it could be executed at 42.40, 42.75, and 42.27. We got a problem here. Dean has 3 what I call acceptable answers, and it looks like that's not going to be correct, because I only have a choice that says, again, I have a trigger, right? I should probably label my work on my official Prometric scratch, because I thought, that's the trigger. So the answer here is Roman numeral 42.75, 4 and 2 and 4. Everybody agree on that one?
Yes.
I like that one. I like that one.
So that, okay, got it. The trigger would not count
Yeah, two separate events. People get hung up on that all the time.
because it says the order would be
Yeah,
executed, not
how
triggering.
embarrassing. Even Dean almost
executed.
got tripped up, right? Because I didn't label my work. I thought I looked back at my little thing and I said, oh, I got 3 here. Oh, no, I don't. That isn't a trade. That's the trigger. And that's why I always hammer two separate events. And again, it's testable because customers get confused. That is not the customer's trade. That's the trade that turned the suspended order into a live order. Under SEC Rule 10b-13, a company is the target of a tender offer must provide its shareholders with a statement indicating acceptance or rejection of the offer within. So, X Holdings is making a tender to buy Twitter at $54.20 for cash. And this question is saying, you as a shareholder in Twitter are waiting for your company to tell you whether you think they should accept the offer or whether they think you should reject the offer. I thought this one was kind of funny because the Twitter said to their shareholders, listen, we should accept this thing. It's, our stock is 30. It's going to take us forever to get to 54.20. So let's take the money and run. So be careful. What say you on this one?
I would say B.
20 is how long X Holdings has to leave up the
I
order.
would think C.
Yeah, it's 10. So 20 is how long the tender offer has to remain open. So in my example, X Holdings, once they make the tender offer, have to leave that open. If it would have said, how long must a tender offer remain open, you would have been correct with B. This question is, how long does the target company have to respond? And that answer is C.
Okay.
So kind of tricky. ABC reports a loss for a year. It's obligated to pay all of the following except. I like this question. What do you guys say on this one?
Report.
Would it be the adjustment bonds? Isn't that like the junk bonds?
Perfect.
Okay.
Right? Income bonds only pay interest when and if earned. So excellent. Boom.
Wait, what'd you say, Ingrid?
Adjustment bonds is like the income bond. They're like the worst. They're like it's what they say. Income bonds are bad. Income funds are good.
Yeah,
And
the income bonds are used in bankruptcies and restructurings.
Mhm.
And retail investors shouldn't be involved in bankruptcies and restructurings. So income adjustment bonds only pay interest when and if earned. So maybe I'm a vulture investor. Vultures are God's creatures too. I'm flying around looking for people that are having problems. And I go to this company and ABC Corp, and I say, hey, you guys are in default on your bonds. They say, yeah, what can we tell you? I said, well, I bought them up in the secondary market. I'm now your single largest shareholder. What I think we should do is I think you should, creditor. I think you should exchange the bonds I'm holding for income or adjustment bonds. You won't have to pay me any interest until you get back on your feet, and then we'll adjust them upwards obnoxiously. Now, again, that's not a retail investor. That's like a hedge fund or, Carl Icahn kind of a guy. So 2 test questions. They're not a retail product, Ingrid's point. If you want income, don't buy an income bond because that's the one thing they don't do, right? They're used in distressed security situations. And then the second point, right? If you want, you can say, well, the income fund is something that you would do for income. Excellent. All righty. So this is very testable. You have A shares, B shares, and C shares. So an investor purchases 10,000 of Class B. So as a test taker, I say, okay, so 10,000 means they have a long-term horizon, but not a lot of money. Because if they had a lot of money, I would go for the A share and get them a break point. So I'm thinking, okay, 10 grand wasn't enough for the break point, but they have a long-term horizon. And so the B share test point is going to have a contingent deferred sales charge. 60 days later, the investor received an inheritance of $40,000. The investor contacts you, now it's 60 days later, and asks about the possibility of backdating a letter of intent. I like this. This is testable. Can you backdate a letter of intent? Yes or no?
Yes.
And how long can you backdate a letter of intent?
90 days.
Yeah, but the problem he has here
They're class B, right?
Yeah. And so, sorry, my friend,
Mhm.
you can't now retroactively change this thing to an
Already
A share.
purchased them.
Yeah. So, maybe we should have got on the A share and then waited 90 days and, then we'd be stuck the other way. But anyways, what do we say? We say, sorry, my friend, class B shares do not have what?
Break
Do not break
points.
point.
If this was a class A share, then the answer would be C.
Mhm.
Right. So sorry, Charlie.
Okay.
Japan discovers oil in the Pacific while earthquakes in England cause havoc.
Hmm.
A customer reads this article would most likely take. So you can speculate on countries. You can speculate on countries, might question your ethics, but if you want to profit from, Japan having earthquakes and right, or Japan discovering oil, and I don't like this because it should be the opposite. England has oil and Japan has earthquakes, but maybe they're trying to trick Dean because that's not how that works. So if we find oil, is that good news or bad news?
Good news.
Yeah, so we would buy calls on the yen,
Mm-hmm.
right? And let's see, England has an earthquake and it's havoc. Good news or bad news?
Bad news.
So we would buy a put. So we're going to buy calls on the yen and puts on the pound. Now, I would comment that a lot of times these questions are really not, a lot of people are traumatized by non-equity option questions. Oh my God, it's a foreign currency option. As long as you take a deep breath and say, okay, well, they have more in common than they do differences. And you just like here, you could just pretend that Japan is a company and England is a company. And just like you would speculate on a company, you could speculate on countries using foreign currencies.
So it's still call up, put down.
That's
Same
right. That's what I'm
concept.
saying. They have more in common than they
Got
do
it.
differences. This is very testable. A customer is in a 28% tax bracket, buys a 9% ABC corporate bond, currently yielding 8.7. Who cares? That has nothing to do with answering this question. She is considering buying muni bonds. What is the comparable yield? This is very testable. So what the customer is saying, what we're asking you is, what do you need in a muni to get the same as you get from a 9% corporate bond? Do you guys know the formula to be applied here?
The multiplication.
Yeah,
That's right. You're either
multiplication one.
multiplying or dividing. So I, as a test taker, use this as my first pivot. I say, oh man, I know anytime they give me the tax bracket, I know what's coming next. It's either going to be a muni and I'm going to divide, or it's going to be a corporate. I'm going to multiply. It's a corporate. So I'm multiplying. And we always have to, regardless of what version, we're going to take 100% or one, doesn't matter, same math,
Mhm.
minus your tax bracket, which in this case is 28%. I think of it as like $1. I think, okay, well, if I have 100 cents, the government's confiscating from me 28 cents. And so I'm only left with 72 cents of my dollar, or $1 minus 28 cents. That's how I like to think of it, but, not testable. But now I'm back in business because I now have that. And now, well, we talked about doing the math, and the reason we want to be able to do math is there's no interpretation of the right answer here. We simply get it right or we get it wrong. I told you I'm terrible at math. So, by the way, test taking trick, I almost can eyeball it and know it's got to be B or C. So I get a 50-50 just by eyeballing the thing. So 9 times 0.72. I get 6.48. Is that what you guys get? You always are ahead of me. You already got it done, huh?
Mhm.
Yes.
Oh. An investor establishes a $5,000 position. That's called cost basis. Cost basis is simply when you turn the investment into money. So that's 5,000. Then sells the share 6 months later. Well, sorry, Charlie, to qualify for long-term capital gain, you have to have held the investment been at risk for more than
1 year.
Yeah.
12 months, right? So this is going to be a short-term capital gain, right? And let's see,
Okay.
100 shares at 60. It looks like I'm going to make $1,000.
1,000. Long term.
Yeah, that's not long term.
Short term.
Oh, sorry, short term. We just went over that.
Yeah.
Get it together.
Yeah. Well, too bad we can't take it as a syndicate. Wouldn't that be nice? It's say, hey, we're going to go down there and take it.
We've talked about
You know,
that
as a
numerous
syndicate,
times.
we all sit on the same chair and then give you separate like things to bring in. I got this one. I got this one.
How nice would that be?
Advantage of oil and gas direct participation programs do not generally include which of the following. So 3 of these things are good things, and 1 of these things is a bad thing.
I'm gonna go
B?
Yeah, I like it. That's not
B.
good. That you might run
I was
afoul
gonna
of
say
the
the same thing,
EMT.
then I questioned myself. I was like, wait.
Well,
Okay,
as a good test taker, and I know you guys are practicing drilling and rehearsing. And one thing I would tell you in terms of we want to model good test taking behavior. And as a good test taker, you want to go with your flash response. You definitely want to trust yourself. Your flash response is always your best response. If you're watching a game show and you're looking at people playing the game show, the good people on game show, they answer quickly, they stick with their original answer.
okay.
Don't use your own brain to outsmart yourself. Now, the only time if you have a flash response that you should change it is if you then know you actually definitely got it wrong and you definitely know what the right answer is. You got to meet both parameters, not that you got it wrong, can't change it still. You got to know you got it wrong, you know what the right answer is. According to modern portfolio theory isn't truth, just a way of explaining things. And the more theory can explain, the better that theory is. An investor can reduce the level of risk through diversification. Adding which of the following securities would tend to reduce a portfolio's overall risk?
I think it's C with the negative correlation. I could
Yeah,
be.
here's an example of this, right? If I own Exxon in my portfolio already
Mm-hmm.
and I add Chevron, I haven't really provided any diversification because those securities have the same kind of correlation, right?
Mm-hmm.
They're in the same business. But if I already have Exxon in my portfolio and I add Delta, the airline, I've added diversification because if we're looking at the price of oil, and now, right, if oil goes up, that's going to be good for Exxon, but it's going to be bad for what? Delta, right? Because Delta flies their planes around, they need jet fuel. And then if oil goes down, so I got it covered either way, basically, right?
Mm-hmm.
If oil goes down, that's going to be bad for Exxon, but it's going to be good for what?
Delta.
For Delta.
Yeah, here, these are going to be the same, good, or bad, bad, right? These have positive correlations. So yeah. Are you guys going on to take a 66?
Yes.
We are.
There's a lot more of this on 66 than there is 7. So a lot more modern portfolio theory on 66 than 7. But indeed, the answer is C. Which of the following are considered sources of debt service for special tax bonds? Not a general tax, a special tax for a special purpose. We could sometimes call these sin taxes.
So 3 is
Two
one.
and 3.
Yeah. License paid,
Mhm.
special liquor. Yeah, you shouldn't be drinking and smoking, right?
Yep.
Right. And, we got to be careful on those taxes, right? Because if we charge too much, people stop drinking and smoking and the bonds default. Depreciating expense, that's a non-cash expense. A non-cash expense is funny money. It is not real money. And so is for investors, all the following except, I kind of like this one. What do you guys say on this one?
I think it's A.
A.
Yeah, I think you're right, right? Because equipment leasing, we have a useful life. We don't get to use assets for free. And so we're going to charge the asset for its use. And that's a non-cash expense, right? Whatever that useful life is. So equipment leasing, certainly. Movie production partnerships. Well, again, we're going to be using things on the set that have a useful life. We're going to have depreciation. And that's going to pass through. And then if we have apartment buildings, partnerships with apartment buildings or hotels or whatever, we're going to have depreciation. REITs, depreciation doesn't matter because it doesn't flow through. So the answer is indeed A. All the following actions would cause a corporation's earnings per share, or which of the following would cause a company's earnings per share to rise? Which of the volume would cause it to rise? So exercise of outstanding warrants. Well, let's just think about it. Earnings. If people exercise their warrants, we're going to have more shares.
Mhm.
Same earnings, but more shares. And so earnings per share is going to decrease under A. Would you agree with that?
Yes.
Yeah.
An increase in the cost of goods sold. Well, that cuts down our earnings, right? That cuts into my margin, right? If my widgets were costing me, $1, and now they cost me $1.50, my earnings are going down. We have the same number of earnings, but we have a reduction in the number of shares. So there's less shares outstanding now. Same earnings, less shares. Ding, 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 ding. Does anybody know how we reduce the number of shares outstanding? The answer is C. Anybody know how we do that?
A reverse.
Well, not the reverse split, treasury stock.
Oh,
What the company does is buy stock into the treasury. Larry Ellison used to own 25% of Oracle. Now he owns over 40% of Oracle, and he didn't use any of his own money to do that. He hasn't bought another share in Oracle since he owned 25%. But Oracle has been buying back its stock into the treasury. And as it reduces the shares outstanding, what happens to the earnings of Oracle? And most importantly, Larry, what happens to his proportion ownership? It goes up.
increases.
Right? And yeah, that's a neat trick, right? So it's C. A 3-for-2 stock split. No, 3-for-2 means, again, you're going to have more shares, but that would have, again, the opposite effect, right? Because you have more shares and you have the same earnings. So that was A. I kind of interrupted you guys on that one, but it's C. I thought that was a kind of a high-end balance sheet question. Would you have got that without me walking you through it?
I think I would have picked A.
Yeah, well, good news,
honestly.
like I say, if you got it, I would say if you can get that, then you probably shouldn't be spending any more time on balance sheets and income statements. A new client opens a margin account, deposits $32,000 and fully paid for stock, which trades on New York. And this point in time, he has excess equity of. He has excess equity of. Now, if you know the classical margin equation, you could just set this account up and just kind of look at it and see what the excess would be by doing long market value minus debit balance, 0 equals equity. Compare it to Reg T. Or you could just know it's half. Here, I could just show it to you real quick. Here is our long market value. Right, I would definitely know the classic margin equation.
Mhm.
Right, and then it says fully paid for, so that means we have the 0 debit here. Boom. So you have $72,000 in equity. Now, this should look familiar. I'm more interested that it looks familiar to you than you can actually do this, but
Definitely.
and then we compare what you have. That's called equity to Reg T. And this is called the classical margin equation. Right, so we're going to compare that to Reg T, which is 50%. And so I say, you have way more than you need here, right?
Mm-hmm.
And so you only need to be at risk for 36. You're at risk for 72. And so I say, you have excess equity of $36,000. You say, Dean, do I have to do something today? I say, you do not. I'll tell you what I'll do. I'll make a special memorandum to your account that you had today $36,000 more than you needed. So you could simply just know that's half, or you could do the classical margin equation. I would hope that you do know the classical margin equation. Long market value minus debit equals equity.
So the reason that you knew that the debit was 0 is because it says it's fully paid for.
That's right. That's correct.
Okay.
Correct. All right. Okay. So I think we're keeping count. How many margins is that? I think that's number 3 now.
3.
Yeah.
And what did Dean say you should probably do instead of trying to learn it?
Just the answer B.
B, stop it.
Because that seems to be what's happening right here.
Oh no.
I promise I don't have any control over the answers being whatever the answers are going to be. Now remember, you still have to learn the information. I wouldn't start just guessing B. Hedge funds. Okay, hedge funds are, what do you guys say about this one?
Ooh, there's
Remember test taking trick. Remember the test taking trick? You can't tell me 1 and 3 in the same universe,
It's not one.
right? The whole point of being a hedge fund is not one.
Right.
It's the whole point of being a hedge fund. I don't want to
Right.
be regulated.
Okay, so 3
Four,
and
so it's
4.
gotta be C.
Right on, right? I'm going to be using investment techniques that are most suitable for sophisticated investors. I'm going to use margin and options and all kinds of crazy stuff, and they're unregulated. So the answer is 3 and 4, right? That's the whole point of a hedge fund. By the way, hedge funds are organized as private partnerships under Reg D. So that means you can only sell a hedge fund to what kind of an investor? A credit.
Accredited.
Credit 1, 2, 3, right? $1 million is net worth,
Mhm.
200, 300, or no hedge fund for you. Which of the following methods of real estate is a flow through vehicle? I kind of like this. I like this one.
C.
Yeah, remember that's the
C.
whole point of partnerships. Partnerships have the flow through. The rest of them do not. Compared to a defined contribution plan. So those are the 2 types of plans. A defined benefit plan. That's where you tell your employees you're going to give them like a percentage of base pay and health care for the rest of their life. Contribution says, hey, I'm not making you any promises, whatever grows to or falls to, that's what you get. So now we got to decide, is a defined contribution plan good for whom?
It's isn't it for employees who have many years?
That's right. So it's going to be 1 and 3. 1 and 3, right? The highest return to employees who are highly compensated. Well, by the way, remember it says compared to defined contribution plans. So, man, you got to be real careful here. So this has nothing to do with answering the question.
Right.
That was just there to mess you up, right? So the question is, this is the part that the question's about, right? And so that would be for your highly compensated people and have fewer years to retirement. I don't know if hardly any employers anymore that still give people defined benefit pension plans. A customer asks his registered rep to purchase $10,000 worth of shares in any pharmaceutical company. So we have action, buy. We have amount, quantity, 10,000. Any pharmaceutical company. We're missing the asset. This is very testable. What type of account would allow you to accept this order?
Discretionary.
Right on. That's very testable. Which of the following types of business organization do not protect a owner's personal assets from losses by the business? I kind of like this. Not the whole question, but part of the question is very testable. We should know that in partnerships, a general partner has unlimited liability. So we shouldn't have been struggling with 1. So we need 1. So that means it's not C or D. So now we have to decide, do sole proprietors have unlimited loss potential of their personal assets?
No.
They do. That's why it's kind of foolish to be running a business as a sole proprietorship, because the business and I are one and the same, right? So if this Dean's mowing service and it's a sole proprietorship and I'm mowing your lawn and some rock kicks up and hits some kid in the head, and there's probably some attorney on TV, has your kid been hit by a rock? Call, in personal injury, right? And they're coming after me for everything. So, it might behoove me, instead of running the business as a sole proprietorship, to do instead a what? LLC or C Corp or something where I don't have that risk, right? So it's 1 and 2. I wouldn't worry about the 2, but I would definitely know the 1. The 1 is very testable. Your mutual fund sent you a 1099 listing some long-term capital gains on which you must pay taxes. You're concerned that the 1099 is an error because you've owned your shares for only 4 months. I kind of like this one. I like what's getting. I don't think it'll be this complex on the test, but What they're getting at in this question is that the holding period isn't based on the customer. The holding period is based on that of the fund, right? So it doesn't matter that you've had it for 4 months, it's how long the fund has had it. So which of the following statements is true? What do you say on this one?
See,
Yeah,
Yes.
yeah, I like that one. I like that one. The other one that shows up a lot on the test is I tell the mutual fund I don't need the dividends and capital gains. The mutual fund has what's called a DRIP, a dividend reinvestment program. And the test question there is I tell the IRS, well, I didn't get the money, so I don't owe taxes. They go, no. You could have had the money. It's the same as getting it. It's on your 1099. You owe taxes. So the other time I owe taxes is even if I'm not receiving the dividends from the mutual fund or the capital gains, if I tell them to reinvest, I still owe taxes on that. Before effecting a penny stock transaction with the customer, penny stocks are very testable. So what do we have to do before effecting a trade in a penny stock with a customer?
They
the
have to
disclosure.
disclosure now.
Yeah, we have to get, make sure they understand they're buying a speculative low price security, right?
Yeah.
And so here, before effecting, the member firm must receive the signed copy of the risk disclosure document. No, I mean, we need to get that, but not before, right? So a member must receive a copy of the risk disclosure document. Verify the customer has, the member firm must. Verify, provide the customer the price of the most recent trade. No, you're correct. On this one, it's going to be get a copy of the disclosure document, right? So it's provide the customer with the price. No, there we go. That's the best one, to show them the spread first. So I say the bid is and the ask is, and then I get all that stuff afterwards. So it's a D as in dog.
Oh, okay. I would have picked A.
Yeah, it's D as in. Yeah, then remember, we don't have to give you this disclosure thing if you're an established customer. How do you become an established customer?
Have a transaction within the last
You
year.
got to do funds with me for a year or 3 penny stock transactions, and then I don't have to give that to you, right? So I would know penny stocks. What is a penny stock? Anybody know what the definition is?
It's any
Stock trading.
Yeah, it's a non-NASDAQ OTC stock under 5.
under 5. Yeah.
Very testable. Oh my God. Well, Dina's lazy. And so you know what I'm going to say on this one. What would I do?
Read the
B.
last sentence.
Yeah, well, I'd guess be in a sign of the universe.
Oh shoot!
I said B.
Really?
No, I'm teasing. I'm teasing. I wouldn't get willy-nilly about that. I'm teasing. What I would do is, you're right. I would want to read that last sentence first because, my God, I'm like, man, this thing is huge. So I need to kind of figure out where this thing ends up at the end of the day. So here I like to read the last sentence first and see where this thing ends up. Which of the following statements is true? Okay, so that's helpful. I know that 1 of 3 of these things are false, and 1 of these things is true. All right, so that's helpful. Sometimes I might even read the answers, before I even get started, right? Just to see if I have one I like. All right, let's see. A retired customer was unhappy with the low yields paid by her CDs. In their first meeting, her registered rep recommended Class B shares of a long-term government bond fund and emphasized the safety of government bonds and provided her with a prospectus. After signing a statement that she read and understood the prospectus, the customer invested all of her money in the fund. A year later, interest rates rose and the value of the fund declined. Having assumed the fund was government guaranteed, she was upset and became increasingly so when she learned that the deferred sales charge could cause her to lose additional money if she were to redeem her shares. Which of the following statements is true?
Could it be? I'm going to go with B.
You are correct. You are correct. Now, did you guess B or did you know
No, I
B?
read it. I was being silly at first, but I was kind of surprised it was B.
The other trick, again, I said I would prefer that you knew the answer, which you did. But
Yeah.
another test-taking trick is too long to be wrong.
Oh, okay.
Too long to be wrong. I go, man, that guy really likes that answer B because it's long, right?
You really went into that one.
So, yeah, the representative should have fully explained the features, charges, price fluctuation, other characteristics of the bond fund. Absolutely.
Mhm.
Absolutely. Which of the following are true regarding revenue bonds? So revenue bonds versus GOs. I would suggest that, take a sheet of paper and on one side, write all the terms associated with GO, and on the other, all the terms.
So it's 1 in 5.
1 in
1 in
4.
4.
1 in
Yeah, 1 in
5.
4.
I saw what time is it, Dean? It's already late. See, it's 1 in 4.
Well, listen, we're almost at halfway, so maybe we should consider taking like a 15-minute pause and come back. But let's go through this. Which of the following regarding revenue bonds are true? They are secured by a specific pledge of property.
Yep.
That is not true. A revenue bond, I don't get the Golden Gate Bridge if they default. I don't get to go take the Golden Gate. I don't get to foreclose on the airport. They are a type of a general obligation bond. Not true.
Mm-mm.
They're not subject to statutory debt limitations. Yeah, debt limitations are about GO bonds, not revenues.
True.
So 3 is true.
So it's
They are
3.
analyzed primarily on the ability to generate earnings. That is true. So the answer is 3 and 4.
Yep.
3 and 4.
I got that one wrong.
That's all right.
I picked this
You
one.
know what I did? I read it. I have to slow down sometimes. Sometimes I just read. I'm like, oh, this says that. And I just.
Well, I would tell you too, ladies, the thing you might want to consider is like every 30, 40 questions, we're at question 60, but you might want to just go and take a little mental trip to Tahiti and then, get your brain going and say, okay, I'm back. And just, make sure you're finishing strong. I had a guy, surprisingly enough, we were trying to figure out what his problem was because he's doing everything we asked him to do. And he said, Dean, it just seems like all of a sudden about, question 60, I kind of drift off a little bit and I get off the road. I mean, it's okay to miss one and get back on track. I said, well, do me a favor, set a timer so but when you get to about halfway, just you set a timer for 10 minutes, go outside, walk around the block or whatever, get some fresh air, come back and see how you do. And that alone took his score up 8, 9 points. So most people
Wow.
aren't wired for 2-3 hours of sustained concentration. Most people can maybe do, 30, 45 minutes. And so, make sure because I think sometimes when people get those high scores and almost pass, I sometimes believe it's just they got tired towards the end. And I know when I get tired, my reading skills are diminished. And then I start missing things, not because I don't know it, just because I'm tired. Right. So you might want to consider that. All right. Now we're about halfway. Do you ladies want to take a little 10, 15-minute break or you want to keep charging?
Can we take a little break?
Sure,
Agree.
sure. So let me pause it and we will come back. All right, well, back to work we go. The FINRA rule on communications would be considered communications that are posted on an online interactive electronic form. You say?
Retail communications.
Yeah, very testable to know the difference between retail communications and correspondence. Retail communications, very testable, is more than 25 prospects or clients, persons in a 30-day period. And the test question is it has to have pre-distribution approval by a principal. Correspondence test question, very testable, 25 or fewer. And the principal can approve it pre or post distribution. We don't care on Series 7 institutional communications because it's not about protecting institutional customers. Ooh, I like this one. Now, remember, I told you the caveat is to remember that they have more things in common than they do differences. And so, if you take a deep breath and don't panic, I think you should be able to get this correct. So if I just told you that was a regular equity option, and I told you the premium was 2.5, and you had 2 contracts, what would you tell me? If your customer bought 2 contracts at 2.5 of anything, what would you tell me?
500.
Yeah, right on. That's the answer, right? They're just hoping you freak out when you hear Swiss franc. Oh my God, it's a foreign currency option.
Oh, because it's 2. Of
Yeah,
course.
it's 2
I had-
contracts. Yeah. Are you bullish or bearish on Switzerland?
You are bullish. Oh, is it the opposite? Because it's international.
No. You're overthinking it. There's nothing in here about a chocolate factory or something. You're speculating on the currency.
Stay quiet for a little while so we get it wrong. Okay.
So if you buy a call on a company or you buy a call on a country, are you bullish or bearish?
Bullish.
Yeah, you're bullish on Switzerland. Now, a different question is about if, I'm a Swiss company, I'm selling, cuckoo clocks in the US, that's a different question. Right? Or if I'm a Swiss
That's what
company.
we said, but you stayed quiet. So I was like, wait, you made us yourself.
What's your maximum loss here? What's your maximum loss?
The 500.
Yeah, right on. They have more things in common than they do differences. A formula tying plan, this is very testable, that consists of periodic purchases of a fixed dollar amount of stock or mutual fund, I would add, regardless of the price, is known as very testable.
That's a dollar plan.
Dollar
cost
cost
averaging. The dollar.
averaging. Very
Yeah.
testable. Dollar cost averaging. So
Oh,
what makes dollar cost averaging work? Fixed dollars invested regularly. What's the end result? You have a lower average cost than those of the underlying shares. And then third test question, does not guarantee a profit. I would say I'd get in trouble with compliance, but most people will get where they're going without crashing and burning financially are people that are dollar cost averaging in mutual funds over the long term. Right? Because you're doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're hot.
and you said lower average cost and what?
Test question number 2. You'll end up, if you will agree to give me fixed dollars invested regularly, $100 a quarter or $100 a month, you will end up with a lower average cost than the average share price. That's a good thing. And the reason you're going to have a lower average cost is because you're doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're high. Very testable. A moral obligation bond goes in default. The only way the bondholders can be repaid is
Through legislative appointment.
yeah, that's called apportionment. Yeah, that's the whole process of getting the vote and sequestering the money. Right on. The MSRB defines an associated person of a broker-dealer who's primarily engaged in municipal securities activities other than retail sales. So this isn't somebody trying to sell, muni bonds. This is somebody who's engaged in other parts of the business, like acting as like a financial advisor, things like that. So what do we call those people?
MFP.
Yeah, we call you an MFP, a municipal financial professional. I don't think that's a test question. I mean, to be honest with you, I don't think you're going to see that on your 7.
Well, I know it, so I wish it was.
Oh, there you go. A new customer has been approved for all levels of option trading. Sign the option disclosure document. I think didn't we see this? I think it's a repeat, is it not? Even though approved for all levels, she knows she'll not be employing, and should not recommend any strategy with maximum loss potential. So A is out because short straddles have what? Unlimited loss.
Unlimited loss.
Spreads are in.
Mm-hmm.
And then short put, this is testable to recognize. I always tell people you don't have to actually do this on the test, but you should recognize that that is not effectively hedged. You still have a limited risk because you don't need an obligation to buy back the stock. Oh, you're not anyway. We have this. You should truly recommend, right? And then D, short calls, uncovered calls are definitely unlimited. So I would know that short stock, short put is not effectively hedged. Still has unlimited risk. 45-year-old investor takes a lump sum distribution from a non-qualified. This is testable. How is the distribution taxed? So whenever you're stuck on a tax question, you always should go with what yields the most to the U.S. Treasury. And whatever yields the most to U.S. Treasury, that is usually the right answer. So the entire amount is taxed at ordinary income. No, because he has a cost basis. Right? He used after-tax money. So 1 is not true.
It's 2 and 4.
It's 2.
Excellent. That's exactly right. It's 2 and 4, right? 2 and 4. Very much a test question. What if he does a random distribution? So he's 59.5 and he does a random distribution. And then it's going to be test question LIFO. Last money is in or the first money is what?
Out.
Out. The indenture is the written contract between the issuer and the trustee for the benefit of the bondholders. And so it would normally include which of the following covenants? Which of the following covenants? Adequate insurance on the property. As a bondholder, would you like the issuer to agree they're going to properly insure the airport or the bridge or whatever it is?
Yes.
Yes.
Absolutely. An increase in the property taxes? No, property taxes aren't
No.
revenue bonds. Property taxes are,
Go bond.
GOs.
yeah, go bonds. Do you as a bondholder want them to agree to properly maintain the asset, the property, the airport, or the bridge or
Yes.
Yes.
the stadium? Absolutely. 1 in 3. In fact, you would be so concerned about proper maintenance that you would probably stipulate in the trust indenture test question a net revenue pledge. In a net revenue pledge, which fund has priority?
In a net maintenance.
Maintenance.
Operations and maintenance, right? As
Yeah.
bondholder, you say, listen, you better damn well operate that thing, maintain it properly, because I don't want to be paid till that's done, because it would be penny wise and pound foolish to say I want my interest as the airport falls apart, right? So that's 1 in 3.
Dean, can I ask you a question? And
Always,
this is off the test, whatever, but I've seen sometimes where they say net revenue pledge or gross revenue pledge, and sometimes when they just say net revenue or
You
gross.
always assume net revenue. Gross revenue would we pay the interest on the bond. So the way I think about it is at the airport, right? I'm collecting all kinds of money. I'm collecting the gate fees from the airlines. I've got the food court, people making their lease payments. I got some retail. I got a parking structure. I got a rental car facility. And so I'm collecting all this money. I'll use SFO, San Francisco, because I'm familiar with it. They have a Bank of America branch right at the airport. How convenient. And so we deposit our money in Bank of America. And the first fund we put that money into is the operations and maintenance fund, the money we need to operate and maintain the airport. Once we have enough to operate and maintain the airport, then we deposit or transfer money into debt service. And so that is the distinction. With net revenue, that would be how it goes, called priority. If it was gross revenue, we would put the money in, we need to make interest payments. Debt service would be first. And then once we have enough to pay the interest on the bonds, then we start depositing or putting money into the operations and maintenance fund. Now, as I said, you should assume net revenue on the test.
But I guess my question too is sometimes I see it with pledge and without pledge on it. And
Well, send me, if it's a Kaplan QID, if it's not a Kaplan question, just cut and paste it and send it to me. I'm more than happy to.
Okay.
I know there's one, I forget which test prep vendor is. Oh my, I think it's only because I'm prejudicial about how difficult past perfect is. So I'm thinking this, I remember it was a past perfect question. The grammar was so atrocious. And it made so many U-turns that it ended up starting with a net revenue, and then they made a 180 on you, and then they made a 180 back. And oh my God. So I tease people that if you are using past perfect, I think we should at some point start a support group because there are companies that use past perfect, and they're poor people. I mean, they've convinced them that tormenting their test takers has some kind of value. But anyways, yeah, there are some complicated ones. The test is not going to be as complicated as test prep vendors. It'll be a little more straightforward. What's the following? Ginnie Maes are very testable. There are 3 things you should definitely know about Ginnie Maes. So I don't know if this is going to be the 3 things, but if not, I will tell you the 3 things. And so they are quoted in 30 seconds or 8s.
Yeah.
30 seconds.
By the way, remember, principal and mutual exclusion means you know that it's got to be 1 or 2 because they're opposites. It's 30 seconds. They're traded with accrued interest on an actual day basis. No, they do 330, 360. These are not the test questions about Ginnie Mae. The 3 things are definitely on the test. Ginnie Maes pay interest and principal monthly. It's the only investment vehicle on your exam that pays interest and principal monthly. Test question number 2, Ginnie Maes are fully taxable. Test question number 3, Ginnie Maes have the direct full faith and credit of the United States Treasury. Those are the 3 test questions. Now, as a good test taker, whenever there's 3 of a thing, they're not going to let you run up 3 points on 3 separate questions. What format are they going to use when there's 3 of a thing?
Except or.
That's right. All the
False.
following are true of Ginny Mae's, except, and then the D choice will be something that's not true of Ginny Mae's. I like this one. We definitely have to be able to contrast the New York Stock Exchange. You know, the New York Stock Exchange has been there since 1792. In 1792, there were no electronics, there were no telephones. You know, if I'm talking to George Washington and he wants to turn his Bank of New York stock back into money, Bank of New York is older than our country. And I say, hey, George, I haven't been able to find you a local buyer here in Tidewater, Virginia. Everybody's like you, they're cash poor. Have you heard of one of the most successful cartels ever created, the New York Stock Exchange? He says, well, Dean, you know, I have. I was inaugurated on the front steps. As well as you know, George, the New York Stock Exchange conducts an auction every day between 9:30 and 4 where they match buyers and sellers. A is the right answer to the New York Stock Exchange. This is about the over-the-counter market. In the 1850s, there's no electronics, there's no telephones. In the 1850s, I would go into Lucas Turner and Company, corner Montgomery and Jackson in San Francisco, and behind the counter would be a guy named Billy Sherman, William Tecumseh Sherman. Before the Civil War, he was a market maker in securities in San Francisco. And over his counter would be a chalkboard. And that chalkboard would have a bid and an ask, a price at which he's willing to buy the security into his inventory at a price at which he's willing to sell out of his inventory. And I could negotiate with him, but if I like his bid, I give him the security, he gives me the money over the counter. Now, all those chalkboards are linked electronically and telephonically. But the answer to this question is D as in dog. It is very testable to know, contrast an auction order-driven market. eBay drives me nuts because it's a single-sided auction. It just drives me nuts, right? On eBay, all they have is sellers. I find that incredibly boring. I think I should be able to go on there as a buyer and put in my bid and say, hey, if you have this asset, I'm a buyer. You know, but all they have is sellers, and you know, that's kind of boring because I don't get to see the spread, right? All the following are allowable municipal bond quotes, except all the following are allowable municipal bond quotes, except. You want to give this a try? I would just on these.
It's got to be A or B, right?
Well, no, this time I let you down because
Would
they
it
aren't.
be- Would it be a
bid-
bona fide quote?
They're not opposites, right? The bid is the price which I buy into my inventory. The offer is what I sell out of my inventory. Those are different things. And then the one is going to be, you should always go with like the unidentified or hidden.
Okay.
Bona fide is Latin for good faith, and good faith quotes are allowed. So if I'm giving you a nominal quote, test question, nominal quotes are for informational purposes only. And so I have to tell you, you know, who I'm using for the nominal quote. I wouldn't worry about unidentified. That's not the test question. The test question would be, which of the following quotes would be for informational purposes only? And then you would say a nominal quote. Which of the following statements regarding a leveraged ETF? You are going to get ETF questions. You have to be able to contrast a traditional open-end mutual fund with an ETF, and you have to be able to contrast an ETF with an ETN. Very, very testable. So this is a leveraged ETF. The leveraged ETFs, again, one of the contrasting points, very testable, is you cannot buy a traditional open-end mutual fund on margin. But you can buy ETFs on margin. One is true and testable. That is one, and it's testable. Why can't you buy an open-end mutual fund on margin?
Because they're redeemed to the.
Because it's a new issue.
New issue.
Okay.
New issue. Can't buy new issues on margin. So one is true. Two, securities within leveraged fund portfolio may be purchased on margin. So can the ETF within the ETF buy securities on margin? The answer is yes.
Yes.
The leverage may never be purchased. Well, we said you can't take three if you took one. Right? If you're taking one, then three's out, right?
Mm-hmm.
And if you're taking 2, then 4 is out, right?
Mm.
So 1 and 2. A CMO makes an interest-only payment to an investor. The payment was
Um,
A.
I think it's A, the ordinary.
yeah, they're fully taxable, very taxable. CMOs like Ginnie Mae's themselves are taxed at ordinary income. I wouldn't worry about this one. What I would know, ladies, is that CMOs, we have 2 asset tranches. Tranches is the French word for slice. And we have earlier cash flows called PACs, plan amortization classes. And we have later cash flows called tax, targeted amortization classes. And what I would know is that the earlier cash flows have more predictability, and therefore, here's the test question, less risk. So PACs test question have less risk than tax. And then we also need to have the investors sign a suitability statement that they understand that they're not buying a Ginnie Mae pool, but rather a cascading cash flow from a Ginnie Mae pool. Those are different things.
What about a plain vanilla?
Plain vanilla would mean it's not a Z tranche, it's not something exotic. So the PACs would be the plain vanilla version.
Okay.
Right?
But they wouldn't give me all 3, like they wouldn't give me pack
Oh
them.
no! Listen,
and
if you
plain
tell
vanilla.
me you missed the 7 because of CMOs, I'm gonna say, nah.
Missed it because of margin,
You
hitting
had
all
bigger
that, the
problems.
B's on margin.
Yeah, if you tell me Marge, I'm gonna say, nah, partnerships.
I'm gonna say no because I only hit B.
Yeah, there you go. I was teaching class one time. It was kind of like us. We got on a roll where every test taking trick was working. And I had to spend like a whole day saying, no, we have to learn the information. Tax preference items. I wouldn't worry about these on the test. The ones that you're going to get tested on as preference items are about the AMT, the alternative minimum tax. And what they're going to test you on is the type of municipal bonds where the interest would become taxable. So I wouldn't worry about this. It's 1, 2, and 3. But I would know about the AMT as it applies to test question, industrial development revenue bonds. Those are called private activity bonds. And it's a binary suitability question. What I mean by binary on the test, it's as simple yes or no. If the investor is subject to the AMT, they should not buy a what? Private activity bond, because the interest to them would be taxable. So I wouldn't worry about these preference items. The preference items I would worry about are private activity municipal bonds. An investor seeking income combined with a conservative level of risk. I miss these all the time because I'm too aggressive. These suitability judgment questions are always a challenge, and everybody's going to miss some of them because I'm a guy who thinks if you're 100 years old, you still should still be 100% equitized. But we could go seeking income, conservative level risk. I think we can get rid of the junk bonds, can we not?
Yes.
Definitely.
And I think we can get rid of the unrated income bonds because remember, income bonds don't pay income. So we have a 50-50, and it says seeking income with a conservative level of risk. So now we got to decide the AA rated mortgage bonds or the convertible debentures. I'm going to go for mortgage bonds. Do we know why it's not convertibles?
Because they want income, and if they convert, their income stops.
Well, you're on the right track. Because of the conversion feature, they're not going to pay as much income.
Oh, I see.
As a straight bond, right? So that's how we get rid of C. We say, okay, well, the convertible thing is kind of cool, but because it's convertible, they're not going to give me a high interest rate.
Okay.
You say, well, Dean, you can switch your status here, and that's why it doesn't pay a lot of money. So it looks like given that answer set, B is our B.
B.
In a margin account, Cynthia exercises her DMF call at 50. And she simultaneously sells 100 shares at 60. What is the amount of her margin call? Wow, that's kind of interesting. In her margin account, she exercises her DMF call at 50. And she simultaneously sells the 100 shares at 60. what is the amount of her margin call? So we got to be careful here because there's a couple ways to attack this question. One thing I might say is I say, well, I'm not sure if this is a same day substitution. And it says exercise simultaneous. Yep. So as a margin clerk, I say, okay, well, I would have, Cynthia, asked you for $2,500. But since you're immediately selling at 60, I'm not going to ask you for any money because these are what we call simultaneous trades. And what a margin clerk does when you do something simultaneous is just net it. Now, only if you do it simultaneously, by the way, right? So if you don't do this simultaneously, then it's going to be a free ride.
But where did you get the 2,500 from?
Half of 5,000.
Oh,
Right. If you exercise a call for 50, that's 100 shares of 50. That's $5,000.
got it. Okay.
Half of 5,000 is 2,500. But here the answer is 0 because we did it on this at the same time. That one's a tricky one.
Wait,
By the way, another margin question. What did Dean tell you to do with margin questions?
Dean, Kaplan's going to catch on to you and they're going to.
Well, I think it randomizes the answer set, I would hope.
Oh, really? Okay.
I don't think if we saw this question again, it would be B again. So I'm pretty sure that it randomizes the
luck of the draw.
Well, yeah, we see. Have you guys, is it always the same when you're doing your Kaplan practice questions?
I don't know.
Is it always B says B the whole time? I would imagine it's going to rotate those answer sets. Let's see. An investor purchased a muni bond at par to yield 5.5. 2 years later, I like this one. Sold the bond at a price 5. So I like this. This is cool. Not testable, but this is called interpolation, where I give you a price and make you figure out a yield. I give you a yield, I make you figure out a price. So how are you going to go about answering this? How are you going to attack this? Anybody got an answer or an idea about how to attack? By the way, I'm not joking. You got to be pretty aggressive as a test taker. You just can't be staring at questions and not come up with, something, some kind of an attack plan. I think what I would have done is try and figure out whether we sold this bond for a premium or a discount. And so the hint here is that if I buy it at par, the yield to maturity is going to be the same as the
year to the nominal
yield, right?
Mm-hmm.
The fixed or stated rate of return.
Oh, okay. I missed the par part.
Right. So if I buy a bond at par and the yield to maturity, remember, if we buy bonds at par, teeter-totter seesaw, all of the yields are the same when we buy a bond at what?
At par.
So now I say, okay, so that means this is the same as the nominal yield. And now they tell me that the yield to maturity for the person who bought it is 5%. And it tells me that I figured out that the coupon was 5.5.
So it would be a premium.
Right on, right? So what we said here, again, this is where we're using our teeter-totter, right? Here's our bond at par. Let me just get a thicker line here. And we did this. That's how we got that 5%. And now we've determined that it is indeed a bond at a premium. So if we bought the bond at par, and now we sell it to someone else, and that someone else pays a premium,
be a gain.
I think we made money, right?
Yeah.
So boom, I like that. That's a good teeter-totter question. Almost always when you get one of these questions about a bond and a yield, you should be thinking teeter-totter seesaw, right? Teeter-totter seesaw. Well, excuse me. Is that capital gain taxable?
Yeah. What?
Yes. It would be.
Yeah, the
Yes.
only component of a muni bond that's tax-free is that coupon of 5.5. So the only part of a muni bond that's tax-free is the coupon, the nominal yield, the fixed or stated rate of return, right? If you buy a muni bond low, par, sell it high, you owe taxes. Which of the following documents describes the role of the general partner and the limited partners? They love to torment you on different documents, you know, on the different documents.
I'm ready.
You want to give this one a try?
I would say A.
You're correct. The partnership agreement. It spells out, you know, who's who, who's doing what. One of the key roles of a registered rep, that's you. You know, when I get a question like this, I go, oh, hey, it's me after I pass my test. So you're matching a securities recommendation, the risk tolerance. All right. Sounds like you're doing the right thing. All the following statements of risk are accurate except. So one of these things is not accurate. And we want to make sure that we are accurate when we're talking to customers. And so now they're asking which one of these things is not accurate.
Systematic risk cannot be eliminated by diversification.
Right on. That's exactly right. That's very testable. Right. There's a tendency of securities to move together. So risk prevails despite your diversification. So that is very testable. I don't think you'll see this in the except format. I think you'll see it in kind of a straightforward kind of a question. Unsystematic risk reflects a particular company, country, or sector. Yeah. I think of unsystematic risk as selection risk, test question. The easy way to avoid it, to mitigate it, is diversification. Systematic risk is a general risk component representing variability of a stock's total return. No. The variance on systematic risk isn't total return. It's beta based on the S&P 500. So B is not true. Unsystematic risk plus systematic risk, no, that's just nonsensical. I like the answer set there. That's a test question. Which of the following is considered a double barrel bond? So double barrel means two pledges. Now I always joke, right? You break into my house. I say, I have a double barreled shotgun. I'm promising you, if I don't get you with the first shot, I'm going to get you with the second shot.
I'm ready.
What do you guys think this one is?
Go ahead, Ingrid.
I think it's A.
It's A, right? The first promise is the user fee. The second promise is the full faith and credit. Did this double barrel bond require voter approval?
Yes, because of
Yes.
Right on, right? Because we, you know, again, the voters are on the hook, so they have to vote in the favor of the issuance of these bonds, right?
Mhm.
A customer buys 10 December 9150 calls for 6.70. At the time of the purchase, the spot rate for the Canadian dollar was 92.25. Again, they're hoping you freak out. And they're hoping you go, oh my God, it's a foreign currency option. They have more things in common than they do differences. If this was an equity option and the premium was 6.7, 10 contracts, each governing 100 shares, would be $6,700. And what did Dean say about foreign currency options? They have more things in common. Can you buy options on margin?
No.
So the margin requirement is 100% of the purchase price.
Okay.
Right? So again, they're just hoping you freak out because it says Canadian dollar.
I thought you had to buy options in a margin account.
No, you have to sell options in a margin account. All opening sales must be, this isn't about a margin account, it's about the margin requirement. Margin means money required for the trade. The money required for this trade is $6,700.
Okay, see that.
If you create an
That's tricky to
obligation,
me.
Carol, accept a covered call. If you create an obligation to buy or sell stock, you're going to have to come up with additional money. You will need a margin account. The way we test you on that is all short sales, except a covered call, must be done in a margin account. Are you bullish or bearish on the Canadian loonie, the dollar?
Bullish.
Yeah, you're bullish, right? If you're wrong on the Canadian dollar, what do you lose?
Just the 6,000.
Premium.
Yeah, it's just like an equity option. This is a freaky one. This is more again Kaplan than it is, the test. But when you have a restricted account, the restriction is you can only have half the proceeds. You got to leave the other half in the account to pay down the loan.
B.
This, again, is more of a test prep vendor thing than it is a Kaplan thing. I had a guy at Merrill Lynch, a very bright guy. And, you know, if you're working hard like you ladies are, I think you deserve to have your questions answered. But he kept asking me the most obtuse option questions. And I'm like, okay, I don't mind answering it, but I really think your time would be better spent elsewhere. But, I was surprised he actually listened to me. He said, okay. Wow. That's not usually the response I get from young men like that. It's like, So this is the one time I'm going to credit your SMA for the half you could have got and did not get. So in a restricted account, the restriction is you can only have half the proceeds, half of the 5,000. But if you don't take the 5,000, I'll credit you for half of what you could have had and chose not to. Again, this is a Kaplan question, not an actual test question. We would have missed our first margin question. And we would have missed it because we would have guessed B. We would have been wrong. And I think we would have been now 5 for 6. I would definitely know what a rights offering is. So our existing shareholders have the first right of refusal on the issuance of new shares. So before we offer those new shares to people who are not our owners, we have to come to them first. And it makes sense that we're going to ask the people that are already in the hot water with us if they would like to provide us, the corporation, with additional equity financing. And so as many shares as you have, that's how many rights you're going to get. And it makes sense the rights are short term because we need this equity financing and we need it like now. And to give you an incentive to come up with this, we're going to pass on the savings of not hiring an investment banker to you. So I call you up. I say, hey, you know that stock you own? You say, hey, Dean, yeah, what's going on with that stock? I said, well, as you know, it's a $50 stock. You say, yeah. I said, they're doing a rights offering and they're going to allow you to buy the stock at 40. And he said, well, that's pretty cool. I said, well, yeah, I mean, being able to pay $40 for a $50 stock, in theory, that is worth $10, right? Because it's, again, a $50 stock. And if you would like to subscribe, we will send your rights and a check into the rights agent, and you will have maintained your proportionate ownership. In theory, something is, worth X, but in reality, something's only worth what someone else is willing to pay for it. And so you say, well, Dean, do these rights have any value? I say they do. I mean, if you don't want to exercise, we should consider selling them to someone else. We should consider selling these things. And you say, well, what are they worth? I said, well, theoretically, it takes here 4 rights to get an additional share. But right now, they're not trading separately. So we can't trade them even if we wanted to. And if somebody wanted to get these rights, they would have to buy the stock first. And so they're less valuable when you have to buy the stock to get this. This is the theoretical value of a right trading cum, right? Because it says the theoretical value before the X rights. And so now we're going to take 10 and we're going to divide by 5. And we find out that these are worth $2. Now, if this was X rights, then we wouldn't add the 1, right? Then they'd be worth $2.50. I haven't had anybody in a long time tell me they've actually had to do the theoretical value of a right. So this is 10 divided by 5, which is $2. The biggest test question is not, can you do the math I just did? Is can you contrast rights with warrants? Can you contrast rights with warrants? What is the difference, test question, between rights and warrants?
Rights are short-term, warrants are long-term,
Right on. What else?
and the rights are below market
Right on.
price.
Very testable, right? You got to be able to compare and contrast them. right? So again, I don't think you're gonna have to calculate. People give me grief because I have a lecture. It says all the math necessary to pass the Series 7. And then goes, oh, you don't have rights offerings in there. And I go, well, because I don't think it's necessary to pass the test because, you know, based on debrief, people tell me they haven't seen this in a long, long time. So. A registered rep recommendations to a customer. So you're making recommendations to a customer, which of the following is true?
C.
Yeah, you must match the customer's risk tolerance with the investment. That's kind of a layup as questions go, right? Another test taking trick, by the way, is called reduction to the ridiculous. In other words, you can eliminate answers by saying, what would the world look like if that were true? You know, what would the world look like if every time you had a recommendation, you had to go ask your principal? Yeah, we would all come grinding to a halt. What are the tax consequences an investor incurs when exercising the conversion privilege within a family of funds? You should definitely know that going from Fund A to Fund B is going to be a taxable event as it relates to Fund A.
Mm-hmm.
And so that's what I would be looking for as a test taker. I'm not sure we have an answer that looks like that, but that's what I'd be looking at. So there are no tax consequences. That is a bad miss. That is a real bad miss because that means you got problems because 1035s are not about mutual funds. They're about annuities and life insurance. The investor treats the exchange as a sale and a new purchase. I would get this one right because it says no tax consequences, no tax consequences, no tax consequences. I only have one that says that there is a tax consequence, right?
Mm-hmm.
So I would have got that right by process of elimination. An investor purchased an interest in a limited partnership, paying $10,000. And then I said, go borrow another 40 on my behalf. And I'm hoping the partnership can pay back the 40, but if not, I've told the bank they can come get me for it. So recourse means I've agreed that if this doesn't work out, I'm going to pay that $40,000 back. So now I'm at risk for $50,000. And the reason I'm at risk for $50,000 is because that note was recourse. If this was a non-recourse note, wouldn't be at risk for the other 40, and my cost basis would only be 10. As I've said, I think all test prep vendors go way overkill on partnership questions. Way, way overboard. Well, I just told you if this thing goes belly up, I said they can come get me for the other 40, right?
Mm-hmm.
So it's 2 and 4. By the way, if it was a non-recourse note, it would be 1 and 3. One of your customers set up a 529 plan for a child of one of his neighbors and contributed for it for some years. Boy, that's a great neighbor. You know, I don't know why a neighbor is financing some other kid. Boy, that kid must have some people skills. Say, hey, could you help me with college? My parents are, you know, I think that one's kind of odd. Anyways, on with the question, right? On with the question. At age 17, it was obvious she had no plans to pursue an education beyond the high school. Your customer decided to redesignate the account. Boy, what an ingrate this kid is. I'm joking. Which of the following would be permissible new beneficiary? What'd say you guys on this one?
B.
I would say B.
Yeah, it's B. It's B for sure. You won't get this 529. You'll get a 529 versus a Coverdale. And then you're going to have to tell me on the test that the 529 is the winner under any comparison with a Coverdale. In fact, I was tutoring a Fidelity guy, and he told me they don't even offer Coverdales anymore. And then I was tutoring an Ameriprise person. They said they don't offer them either. So, you know, just proof that Coverdales suck as compared to a 529. In a lot of ways, I mean, how much college can you buy for $2,000? Not a lot, right? Coverdales are only $2,000. You know, 529, you can really get some serious money going, you know, and Coverdales are means tested. You know, you can't have them in certain things. So I'm not surprised. I just saw a stat that said of the educational marketplace, about 1% of the funds are in Coverdales. And I would imagine those are dormant Coverdales that were funded at some other point. A customer is choosing a payout for a variable annuity. This is very testable. Maximizing monthly income, test question. The annuitant has no living relatives, so beneficiaries are not concerned. This is very much a test question. What gives you the biggest payment?
Great life payout.
You can't miss questions like that. Angels wait for you if Dean tells you it's on the test, and then it's on the test and you still miss it. That's going to be a long time down there, right? You got to make sure you get the ones that we know are there. Your customer purchasing a Gref stock buying strategy. Which are the most suitable? I kind of like this. Beta is a measurement of volatility. And here, if we're aggressive, we need volatility. It's our friend. We need this thing to move. So what are we going to go for?
Higher beta.
The highest beta,
Okay.
right? So there we go. Boom. Right. Aggressive. I'm going to get you high beta. Oh, I think these are the toughest spread questions. So here we go. Time for you to once again prove your prowess that you told me you had in options. You said, Dean, I want 125 options. Okay. Let's see how you perform on this. Anybody got an answer?
Bull spread.
What kind of bull spread?
Big debit.
Excellent. That is the hardest thing to get on, I think, judgment questions as it relates to options. You are correct. This is a debit bull spread. How did you determine this was a debit bull spread?
So I looked at both of the calls. So the call, you always go by the lower strike
That's
price
exactly correct.
if you don't have a premium.
That's correct.
So I went by the lower strike price. It's a buy, so I already knew it was a debit.
Yeah, there you go.
And it's a call, so I already know it's a long call, so I already know it's bullish.
Perfect.
And I
Excellent.
wanted to widen.
Right on. It's a debit spread. And remember, you can do a lot of things. Excellent. So far, you were proving your claim prowess. You said debit, exercise. How about premiums? You want the premiums widen or narrow?
The premium. Wait, sorry, I missed that question. Say it again.
You told me it's a debit spread.
I wanted to widen.
There you go. Indeed. What does the gain and the loss add up to?
So it would be 10.
Yeah, we don't know what it is, but it's test taking trick. It's got to be two numbers that add up to 10. We don't have them here, but if we had the premiums, we would be bad form to say the gain and loss is anything that doesn't add up to 10, right? There's a floor at 50 and a ceiling at 60. All right. Good job. Excellent. A customer wants to buy shares of ABC on margin while ABC is engaged in an IPO. How many days must you wait? These are ineligible securities. It's considered a new issue. How many days from the effective date?
30.
30. So that's why you can't buy open-end mutual funds on margin, right? Because they're new issues. A customer is long 200 shares at 30, 400 shares at 20. The debit balance is 8,000. The customer sells 200 shares at for 4,000. What is the credit to the SMA? So I think what I would have done is got out my calculator and said, okay, well, 200 shares at 30 is $6,000, and 400 shares at 20 is $8,000. So I'm going to have 6,000 and I'm going to have 8,000. So I'm going to have 14,000. Boom. Right. And again, how did I do that? I took the 200 shares times 30. That's 6. And then I took the 400 shares at 20. That's 8. And that's where I got that 8 plus 6. Well, again, it doesn't help there. Now I got to do debit, right? And it tells me the debit is 8. And again, I'm noticing something here. It looks like this guy is below 50%. And what we say when you're below 50%, your account is restricted, right? There's our equity. And again, I'm just going to compare that to Reg T to see if perhaps I can't loan you more money because I love loaning people money. And so Reg T is 7. And it looks like your account is below 50%. The restriction on the account is $1,000. And so now you sell 200 shares at 40. And so if I sell 200 shares at for $4,000, so this now goes to 10. If I'm a margin clerk, and you sell securities, I pay down the loan. If you owe the broker dealer money and you sell securities, all of the proceeds are going to pay down the loan. That's how margin accounts work. If you don't want me to do that, then you need to say something, because otherwise I'm taking that $4,000, I'm paying down your loan. You still have here $6,000 in equity. And again, I'm going to compare that to Reg T to see if perhaps I can't loan you more money. And so I'm going to compare that to this. And it looks like the answer is going to be 1,000, but it's not. You recall why this answer? I told you this is more of a test prep vendor question than an actual question on the test. But remember what we said when an account is restricted and you sell securities? I told you if you leave all the money in the account to pay down the loan, I will credit you for the half you could have had. And so it looks like that's going to be 1,000, but I say, no, I'm going to let you have half of the proceeds as an SMA entry. That is the only time that I'm making an SMA entry that isn't a function of mark to market. I get so many people who send me this kind of a question. I go, I thought I was getting it. I said 1,000. I said, well, you would have been right in every other circumstance, except this is a sale of securities and what kind of an account? Restricted. So that's the only time. Now, looks like we would have missed this with the B strategy. I wouldn't worry about that at all on the test. A customer of yours expresses interest in purchasing a deferred variable annuity. After careful analysis, you've determined this is a suitable investment. Under FINRA rules, the principal approval must be obtained by, there's heightened suitability under variable annuities.
7 days.
Yeah, it's going to be within 7 business days, right on. I don't think you'll see that, but it's a recognition question. All the following are advantages of buying a put versus a selling short. I say, don't be a dumb bear. Buying a put is a smart bear. So we're asking about buying a put versus shorting the stock. So they're both bears. True or false? Buying a put has a lower dollar loss potential. You should definitely know that, right? If you sell short the stock, what kind of risk do you have?
You're just losing your premium.
Yeah, and that's much better than unlimited, right? So A is true. The put's time value gradually dissipates and is added to the intrinsic value. It depends on which way it's going. I'm not quite sure about that. One need not locate securities. That's true. Buying a put requires a smaller commitment. Yeah, time value is separate from intrinsic value. That's just nonsensical.
Mm-hmm.
There's time value doesn't get added. It's time value, whatever that number is, could be 0, plus intrinsic value, which could be 0, equals the premium. So tough one. That was B. But you should definitely know that it's smarter to buy a put than short the stock. This you should definitely know. And this you should definitely know. Yeah, I was in a chat room. I was a bear. I said, are there any bears in the woods? And this lady pops up. I said, well, listen, you and I got to start battling with all these bulls here. They all think the stock is going to go up, and we got to convince them it's going down. And she said, what have you done? What's your position in the stock? I said, I haven't done anything yet, but I think I'm going to buy 10 of the 40 puts at 4. It's going to cost me $4,000. I think that's what I'm going to do. And then I have to be right about 3 things: direction, down, how far, 4 points. And anyway, she said she sold the 40 calls naked. I go, well, I certainly ain't doing that. So that's not so smart. Then she told me she didn't tell her husband. I'm like, TMI. Determining a violation of position limits. I like this. So what this is asking you, so sometimes the challenge I had a guy I was working with, and I said, tough love. I said, you're not at a spot yet where you have enough base knowledge to be even doing questions. I mean, because you can't even read a question, know what you're being asked. And so you need to start, work on laying base. And I thought it was kind of funny. He called me because, Dean, I think I'm halfway there. I go, what do you mean? He says, well, I can actually now understand what I'm being asked. I don't know what the answers being offered are, but I know what the question is. I go, okay, I agree. That's 50% there. Yeah, get both. So here, what I'm being asked is about the same side of the market.
It's A, right?
You are saying A, and you are correct, right? So a short call is an obligation to sell the stock. A long put is a choice to sell the stock. And you are correct. That is the same side or bearish side of the market. And position limits apply to the same side of the market. So this is the bearish side. What would be the bullish side?
Or put in a long call.
Excellent. Well, you ladies, you are proving that you got options down so far. Before making any recommendations to a client, suitability must be gathered. Many suggest beginning with a family balance sheet. What would be found on that document?
What would be found on the document? Balance sheet.
What is the
Net-
classical balance sheet equation?
Net worth.
There you go,
Yeah.
right? That's assets minus liabilities equals what?
Net worth.
I say, Carol, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be determining suitability. One thing I'd like to do is take a picture in time. What does your financial situation look like as of October 1st, 2023? Could you tell me about your current assets, cash, or things you plan to turn to cash within the next 12 months? Let's go over some of your long-term assets, your house, your car, your retirement plan. Let's go over your current liabilities, things that need to be paid within the next 12 months. Let's go over your long-term liabilities, your mortgage, your car payments, and let's establish your net worth, and then let's revisit this. Corporations revisit this every quarter. Maybe we do it every 6 months, whatever the case may be. After I get that done, Carol, what I like to do is go over an income statement. I'd like to see, how much money you got coming in, how much money is going out, and kind of see what your top line is and your bottom line, and see if we can't find some opportunities perhaps to redeploy some capital, right? So very important. It's called your know your customer role. An investor owned FLB stock for 2 years, buys an FLB October put. This will.
And something about the holding period, right? Like it would end.
Well, if we had not already been at risk for more than a year, which we have.
Okay. Oh, okay.
Oh, 2 years. Okay. We
Yeah,
just
so
talked
that's
about this
key.
the other day.
Yeah, it doesn't interrupt my holding period because I've already had it past a year. If I added the put like 6 months in, that would interrupt my holding period. Right, I have to start over. So the key thing on this question is that we've already met that long-term capital gain holding period.
So it's got to be anything less than a year?
Less than a year, then it would end my holding period. And by the way, it wouldn't cause any gain or loss. I would just have to start over on being at risk for 12 months because once I put in the hedge, I'm no longer at risk.
Okay.
Right. Again, more of a test prep vendor issue. Was it you ladies? I put up, somebody wanted, I think it was maybe your syndicate. Did we do tax consequences on options?
No.
Was that you guys?
We did a tutoring session with you on that.
Yeah, I think it was like, I think we
That
did.
was ours that you put up. Yes.
I think we did a whole hour on that. And, I thought it was pretty good. Of course, I thought it was pretty good because I did it. Which of the following best describes intangible drilling costs? This is part of, drilling, but not actually like drilling the hole or doing that kind of thing. And again, I think all test prep vendors, including Kaplan, go way overboard on partnerships, including this. I would be very surprised
Oh,
you see anything about a tangible drilling cost on your actual exam. Companies offering an investor an opportunity to purchase shares for the next 5 years. This is very testable. Can't be a right. Can't be a right because it's 5 years. It can't be a right because it's above today's current market price. Very testable. It is a
warrant.
warrant that is very testable. Warrants are typically sweeteners. There you go. Municipality share of debt issued by authorities that draw revenues from the same sources as the municipality. I think the grammar here, language is very weird, but the test point is valid.
Overlapping,
What do we call this?
overlapping debt.
Yeah, right. I'm coming to you from Las Vegas. And Las Vegas is 100% coterminous with Clark County. And so I'm responsible for some of the debt for Clark County, and I'm responsible for some of the debt of Las Vegas. Las Vegas is 100% coterminous with Clark County. You can't be in Las Vegas and not be in Clark County. Clark County is not 100% coterminous with Las Vegas. You could be in Henderson or Centennial or whatever it is. So when I ask my real estate agent, how coterminous is my home? I'm asking how many people are looking to me for property taxes, right? So it says here that draw revenues from the same sources. What they mean is the taxpayers, the same taxpayers. I like that question. I don't like the phraseology, but the test point is valid. What is not considered a short term? Oh, man. That's an aim and shoot, point and click. What do you ladies say on that one?
Treasury
B.
bonds.
Yeah,
Oh,
treasury bonds, right?
oh, yeah.
Repurchase
I'm
agreements.
thinking bills for whatever
Yeah,
reason.
yeah. Commercial paper is negotiable jumbo CDs. Repo is where I agree to reverse a trade the next day. And that's a type of money market instrument.
Mm.
Moderately risk investors can best be described as an individual. I think these ones are challenging. So a moderate risk adverse. And the reason I think they're challenging is because that's actually, I think, different for whoever you're talking to, right? So, but well, given this answer set, I should have been able to eliminate. I think I would have done this through process of elimination. I know D is out. I know that B is out, right? Because moderately risk averse. So that means A or C prefers investment with less risk to those with more risk if the riskier one offers a higher potential return. I don't care for the question. I think I would have used too long to be wrong.
That's what I would have picked too as A.
I don't have anyone other there that's better than that. We might miss that one, but I don't think any of those others actually kind of make sense. Anybody like one better? Anybody got an answer they like better than A?
No, that's fine. I would have picked that too.
Yeah, I think A is what I would go with on this one.
Mm-hmm.
The DERP Corporation. I think I lose it here a little bit because I think, oh, how clever. DERP is one of our memory aid devices for declared X record payable. It's a rights offering. Rights offerings are short-term exercisable below. The common stock is 45.50. So being able to buy the stock at 40 when it's at 45.50 is worth $5.50. I get one share for 10 rights. It takes 10 rights to get one share. What is the theoretical value of a right? Theoretical because something is only worth what someone's willing to pay. But being able to buy the stock at 40 when it's 45.50 is worth $5.50. Takes 10 rights to get it, and now you can buy the rights in the secondary market. So 550 divided by 10, 55 cents. I told you I wouldn't worry about calculating the theoretical value of a right. It's more of a test prep vendor situation than it is the actual exam. But I would know rights are short-term, exercisable below. If a customer puts in a buy order for 800 shares of WXYZ, your firm gets a quote from market maker for 800 shares. The response is bid 15, ask 1525. The order is placed, the market maker must. Right, customer's buying, I'm selling. So at what price does the market maker sell?
At the ask.
Right on, right? So I'm gonna have to sell 800 shares at
1525.
Very testable. Know your bid from your ask. You know, you got to know your bid from your ask. I have a whole lecture, know your bid from your ask. What if I failed to honor that quote? Test question. A market maker fails to honor a firm quote. This is a prohibited practice and is known as, very testable, backing away.
Backing away. I was going to say selling away.
Backing away, very testable. So they'll say on the test, a market maker fails on a firm quote. This is a prohibited practice and is known as, and you got to come up with backing away. Freddie Mac does which of the following? Well, you should know it doesn't purchase student loans, so you should enable him in the 2, which means you're taking what?
Mortgage loans.
Yeah, and you should definitely know it's not 4 because Fannie Mae, and Freddie Mac don't have the full faith and credit. Only Ginnie Mae does, right? So by eliminating 2 and 4, we know the answer must be 1 and 3, right?
Mm-hmm.
I wouldn't worry about Freddie Mac on the test. I would definitely worry about Ginnie Mae. Someone considering saving for retirement in Roth IRA could correctly be told, man, Roths are sweet. And again, what you have to be able to do is contrast a Roth on your exam with a traditional IRA. How are they different? I think Roths are so sweet, it should be a test question about legislative risk. Are contributions made with pre-tax dollars? Yes or no?
No.
No.
No, that's no, right? So we got to get rid of 1.
Yep.
So 50-50. The earnings accumulate tax-free, yes or no?
Yes.
That's true. So we need 2. Distributions are not taxable if the holding period is satisfied.
True.
Yeah, these things are sweet. Is there a required minimum distribution?
No.
No RMD. That's very testable. All the following expenses to the operation of a mutual fund except, I like this one. I like this one. Do you have an answer on this one? Does the mutual fund pay C? No. The mutual fund doesn't pay C. Who pays that? Your client. That's the load, right?
Yes.
That's what the customer's paying, right? That's not what the fund's paying. So who pays the 4% or the 8.5% or whatever it happens to be? The customer, right? The customer.
Okay.
Listen, I was tutoring a guy earlier who's a wholesaler, and he works for a fund distributor, and his job is to help people sell. And I said, man, I wish maybe more baby brokers knew about people like yourself who can help them, because I would have never made it in this business if I didn't have a wholesaler, a guy who works for the fund. You got to write a distributor. The maximum test question, this guy is an associated person of a FINRA firm, the distributor underwriter. And what is the maximum gift or gratuity he can give you to sell his funds? What is the maximum gift or gratuity an employee of one member firm can give to the employee of another member firm?
$100.
Right on. Very testable, right? Doesn't count normal deductible business expenses. So he says, hey, Dean, why don't you do a seminar? Invite your prospects and clients. I'll pay for the pizzas and sodas. No problem.
Mm-hmm.
All right, ladies. Another opportunity to demonstrate your prowess in options. Investor sells an AMF April 50 put at 2.5, buys an AMF 60 put at 7 3/4. The investor has a profit. By the way, this is a spread. Spread always means the difference.
It's 60.
So is it a debit spread or a credit spread? Is it a debit or credit spread?
Debit.
I'm sorry, I have you on mute.
No, that's right. So debit is, once we get debit, we can rock and roll. Mountain Dew.
Biden.
Mountain Dew, do the do like Nike. Or when you're like, Dean, and you're wide, you need to exercise. Right? I joke, in some cultures, this wideness is a sign of wealth and prosperity. Unfortunately, not in our culture, right? Yeah, that's Carol. Like I like Asia, because in Asia, I like a happy Buddha. Right? Are we clear? It's debit exercise widen.
Yes.
So what is that? 2 and 3. Just since we're here, we're practicing our skills. We're practicing our skills. What is the maximum loss in this spread?
The maximum loss is gonna be,
Yeah, anybody offers me a calculator, I'm taking it because my arithmetic is terrible. So I'm going to take 7.75 minus
25.
and $525
Mhm.
is my maximum loss. There's $1,000 to be made or lost, 10 points. And of the 10 points, I spend 5.25. So my maximum gain is $475. The break even is somewhere between 50 and 60, bad form on a test to take an answer that's somewhere above 60 or below 50. So what is the break even on this?
55.25.
Well, I don't know because I didn't do the math. You probably are right. Let's see if we're going to use put subtract from the higher. So we're going to take 60 minus the net, which whatever that was, and that would be the break even. Is it bullish or
Bearish.
Right on, ladies. Man, that's impressive. You guys your options performance has been very, very impressive this evening. The Options Clearing Corporation, lots of test questions about the Options Clearing Corporation. They're the issuer and guarantor of all options. They publish the OCC disclosure document, which I have to give you at or prior to opening the account. They exercise options randomly. Lots of test questions. The Options Clearing Corporation automatically exercise an option contract that is in the money by, if I want to give this a try.
One penny.
Penny.
Yeah, excellent. Excellent. Right on. 2 and 3. All the following are characteristics of both oil and gas as well as real estate, except. So I kind of hinted on this one. Do you recall what I said about oil and gas? I don't know how much oil I have down there, but I do know that if I pump a barrel and sell it, I have one less. And so I get a tax incentive for a natural wasting resource like oil, like gold, where, again, I don't know how much gold is in my mine, but when I mine an ounce and sell, I got one less. And that is a test question. That goes with depletion, doesn't go with real estate. Right? The grammar's atrocious here, but depletion only goes to what kind of things? Natural wasting resources like oil and gas. These other 3 are common to all partnerships. Lindsay Wolf, she's a public school teacher. I'm immediately thinking TSA, but then they tell me that. I should know that without them telling me that she is eligible. Contributions total $50,000. The current value is 20 or 200. You should definitely know tax sheltered annuity. She has no cost basis. So everything coming out of this thing is going to be taxable. She's still teaching full time. When does she have to begin? This has changed. The RMDs are no longer 72. This should be 73. So I'll make sure I tell Kaplan they need to update this question.
And the
RMD,
penalty has changed as well. Is that
well, the
correct?
penalty is still 10 if you get it early. There's catch-up positions, but
No, the 50%.
50% is if you don't
take
take the
it?
RMD. That's still, I think that's still 50. They don't test on that.
Still 50.
They do test on the 10%, and they do test on the RMD at 73. Right. So she has to withdraw this at age 73 or when she's no longer working, whichever is later. I don't think you're going to see that. You're going to get tested on the who gets it, the employees of the educational establishment, not teachers. By the way, I don't like that just teachers because people miss questions. Does the janitor at the school get it? Yes. Does the nurse? Yes. Not students. And then you should definitely know employees of nonprofits also get it. All of them are covered by FDIC insurance, except one of these is not a bank account.
Would it
What
be
you
a
want-
fund?
Yeah, that's a mutual
Mhm.
fund. That's not a bank account.
Mhm.
Right? That's not a bank account. A is a checking account, C is a bank account, and D. Do you guys know what the coverage is?
250,000.
Yeah, it's like SIPC, but it's 250, right? Rodney borrows funds to purchase municipal bonds. That sounds pretty stupid. Which of the following regarding the interest on the loan is true? We're not going to let Rodney double dip, and usually you conduct financing charges for your investments. The exception is the buy munis, because that would be a double dip to say, for example, Larry Ellison uses his margin account to finance his other investments. And, he gets to deduct that interest charge of $200 million a year that he pays to Morgan Stanley. So, for example, he bought the island of Lanai using his margin account for $500 million, right? And then he, bought a bunch of houses in Malibu and used his margin account because, he doesn't want to sell his Oracle stock. And he gets to deduct the $200 million a year unless he uses it to buy muni, then it's going to be taxable. People are giving him grief about his margin accounting, because I don't like people give me grief about my margin account. Because do I pay Morgan Stanley a couple $100 million a year in interest expense? I do. Is my debit balance $20 billion? It is. He said, but I have $100 billion in collateral. It's not a big deal. Which I lived in his world, right? At 3:55 p.m. Eastern Time, registered rep receives a market order from an officer of XYZ. To buy 75,000 shares of XYZ for the company's account. So this is treasury stock. And, we're not going to allow an issuer to manipulate their own stock price. It looks like this might be a problem about marking the close. And so what do you say in this scenario? We should, as a test taker, recognize that there's a red flag here that he's trying to do this trade towards the end of the day.
See?
What should we tell him?
We can't just refuse it. It's got to be.
That's right. I like that. I like your logic there. You're saying, well, Dean, I got to tell him what's going on.
Okay.
I think here of a guy named Hank Greenberg. Hank Greenberg called his designated market maker, the specialist. He said, I have authorization from my board to buy stock, and I want you to buy as much stock as you need to keep that stock today at the close at 75. And the designated market maker said, you understand, you're asking me to peg that stock at 75. And I should advise you, there is no safe harbor for what you're asking me to do. I will do it, but then it's going to be on you. And then, Hank Greenberg said, whoa, hey, no, I didn't mean that. I'm sorry. So we don't allow.
Dean, why would they place the order and not refuse it if they know it's like?
Well, no, it's safe harbor. It just means that I'm not liable for following a customer's instructions if I've already warned him about this. And what it is here is we're not going to let you go. It's called marking the close. And
So as long as you advise them, then you're free from.
In this scenario, because there used to be a safe harbor. Safe harbor means a way to do it and not get in trouble. Okay. And so that's what safe means legally. Like my brother just sent me, he's very proud of his pot plant. I don't smoke pot. But, he's been raising his own pot plant for personal use, and he's allowed, and I said, Chris, what are the safe harbors about pot? I'm sure there's rules. He said, well, I'm allowed 3 plants, and I can't, you got to know what the legal ramifications are, right? So that's what we're telling this guy. Here's our safe harbor, right? Reg D is a safe harbor under 33, a way to sell unregistered securities, right? So the answer is B. I think it's more of a 24 question than a 7. A registered rep has been doing some research on his own. Oh, man, and that's silly. We have a research department. I don't know why he's doing his own research. He would like to share that with some of his clients, and he sends an email to 15 of them. He also has some prospects he's been working on and sends email to 12 of them during the same week. I like the question. I don't really like this rep doing his own thing, but I told you it's very testament of the definition of retail communication versus correspondence. And so here I'm looking at the question, and it's 15 and 12, and that adds up to
27.
And so that means it is
retail.
Boom, that's very testable, right? And then remember, that means it requires principal approval pre-distribution. Which of the long statements regarding corporate zero coupon bonds is true? If you said one, you should flunk the entire exam. Because you should definitely know that zero coupon bonds do not pay interest what? Semi-annually. Zero means zero coupon means no coupons, no interest payments. That's what zero means. So we should have been able to eliminate one. The discount is in lieu of those payments. That's true. This is very testable. The discount must be accreted and taxed annually. Indeed, it's 2 and 3. That's very testable. What do we call that concept? That you're paying taxes on money you're not actually receiving.
Phantom tax.
Phantom income.
Oh, there you go. Phantom income.
Right, phantom income. So that's very testable. A mutual fund invests in bonds with medium length maturities. As the bond matured, the fund reinvested the proceeds with long-term bonds with maturities up to 20 years. What might have happened to the fund if the reinvestment occurred during a period when interest rates were rising? I like these. These are the toughest questions, I think. These are judgment questions where you go, oh, man, okay, I guess I got to think this thing through. So what would you say about that scenario? So I have bonds that are maturing, and I'm buying new bonds as they mature, and it tells me interest rates are rising. So I'm going to be able to buy bonds that have a higher yield
Right.
and provide me with higher income, right?
Correct.
And then the bonds in the portfolio, nothing here about price. The price of my existing bonds are going down, but that wasn't the question. Benefits of muni bonds, advance refunding. So what is advance refunding? You know, I'm a municipal financial professional. Remember what that means? I'm not a broker. I'm more of like a banker guy. And I call the issuer and I say, hey, I've been doing some homework and I see that you have these bonds that you're paying 5% on. And, right now, brand new munis of similar credit quality, similar maturity pay 2. And you say, well, Dean, if you did your homework, you know that they haven't passed the call protection period. I can't call those bonds even if I wanted to. I say, I know. What I would like you to do is, and I'll help you with this, is what I do for a living. What I'd like you to do is sell some new bonds here today at 2%. Take the proceeds, we'll put it into a escrow account. We'll buy state and local government bonds, slugs. And that way, when the bonds have passed their call protection period, we can call the bonds. What I'm suggesting is we do advance refunding or pre-refunding of the bonds. And they say, well, what did that cost me? It's not going to cost you anything because, we're borrowing at 2. We're going to invest in the escrow account at 2. And by the way, kind of cool, those old bonds you have outstanding at 5% are going to be considered defeased or retired. You can remove those from your debt statement. Those bonds are going to be AAA because you owe the money and you've already got the money in an escrow account. And, moving forward in the secondary market, those old 5% bonds will be quoted on a yield to call basis. All right, so now they're asking you, the benefits would include a decrease in the issuer's current interest cost. No, you're still paying interest on the 5% bonds. Tax savings, no. A higher rating on the old bonds and greater marketability. Ding, 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 ding. Right, those bonds there are going to be AAA.
I would have picked A on that one.
Well, no, because you still got to pay the interest, the 5,
Right.
which is the 2s aren't costing anything. I think the confusion, these are high, low probability questions, but where people miss this is they're confusing the old bonds with the new bonds. So we got the old bonds at 5 and the new bonds at 2.
You still have to pay all of the interest.
That's right.
Okay.
The market price of a convertible bond depends on all the following, except. I'm not a big fan of this question, but I kind of like it, what they're getting at, like, what's more important versus what's less important.
Would it be like the
Go ahead. Yeah, we don't care about the other companies, right?
Okay.
We care about interest rates. We care about what the value of the underlying stock is. Extremely testable. Parity of the bond, parity of the stock. We certainly care about that relationship.
I wish we would have gotten some
Relationship is
convertible
test.
bond questions.
Well, that's definitely testable. And then the rating of the bond, certainly. The rating of the bond, certainly. Oh my goodness. Well, here we go, ladies. Another opportunity to demonstrate your prowess. So we're looking for a spread, remember, is long and short,
Mhm.
the same type of contract.
Okay, I'm ready.
Okay.
Everybody think they got an answer here?
A.
You say A, which is 1 and 3, and you are correct. And how did you do that? Excellent. Boy, I think spreads missing premiums are the most hardest things to do, right? And so 2, long and long, that's not a spread, right? 1 certainly is long and short. Let's look at 4. Long and short of put. Nope, that's the same side of the market. And so 1 and 3, excellent, ladies. I'm very impressed with your options performance. In a competitive bid, which of the following would the issuer need to determine the net interest cost? So when we're bidding on bonds, we do it based on the net interest cost, and that is certainly, again, based on what we have bidded for the bonds. The higher the bid, the lower the net interest cost. And so we're certainly going to be interested in the coupon rate and then the price we're going to pay. I wouldn't worry about this at all on the test, but it's 1 and 3. You know, the coupon rate for the bond, and then what we've bid is a syndicate for the bonds. And that's called lowest net interest cost. So whoever gives us the highest price, the issuer wins the underwriting. Again, wouldn't worry about it. Following 529 plans are true, except 529 is very testable, usually in connection with contrasting it with a Coverdale. And what say you on this one? True, except. Very testable. They are not subject to income limitations. Very testable. True or false?
They're not subject to income limit. So true.
That's true. Withdrawals at the federal level for qualified educational expenses are tax-free. True or false?
Ingrid, go ahead.
I think that's true.
That's true, but say it with confidence. Get rid of the word I think. Say it like it's true. You know, I was teaching a class this last week and they kept putting question marks in the chat. I said, just make it an exclamation point. I will know it's a question mark, but I want you to get in the habit of exclamation points, not questions. Right. So just get rid of the thing I think. If you're going to go down, man, go down strong. Just go down in flames like it's true. And I'm going to challenge my score if they say it's not. There are high contributions limits. Absolutely. Right. You know, President Obama did this for his girls. They're tax deductible. True or false? Are your contributions tax deductible?
No.
That's false.
Yeah. You know what you might want to do as a test taker is maybe on your official Prometric paper, do what I kind of did. I like to go to each of these and just put, you know, a T or an F. Maybe I don't know, but if I don't know, I do that. And even if I can't answer all of them, then I can kind of get a 50-50. And so that's what I like to do sometimes is just put like T's or F's next to it and see if I can't, get a 1 in 2 chance. Which of the following statements describes an oil and gas blind pool? I would know the definition of blind pool.
You sure did give us a lot of oil and gas.
I'm with you.
But no convertibles.
I'm with you. So oil exploration occurs in an area that is not adjacent to any known oil reserves. An unknown number of representatives participate in the sale of known partnership units. The income from producing whales is purchased at a discount from the present value. Money is raised without a specified property being stated. Ding, ding, ding. That's what blind pool means. You give me the money and then I go find the investment.
Mhm.
Nothing wrong with that. I can get a better deal. It's just more risk, right? All the following statements regarding tax treatment and interest received from CMOs is true, except. So one of these things is not true. One of these things is false.
B, because it's fully taxable.
Right on. I love how you attack that. That's exactly the right attack plan. Boom. A new client, 25, earning 41 grand. Oh, to be young. Has saved 20,000. That's very impressive. I'm very impressed. I know when I was 25, I didn't have 20 grand saved up. To allocate to an investment portfolio for the first time. Wow. He conveys that while I'd like to see some growth, an investment with moderate risk and some downside protection are important objectives for his first time investing. Aligning with the client's investment experience, which of the following would be most suitable? I would definitely toss out the muni. Munis for rich people. I mean, someday maybe he needs a muni bond, but he or she doesn't need one now. We can toss out the money market fund because he needs to get going, he or she, right?
Mhm.
So now we're down to A or B. And what do you think? A balanced fund, some stocks and bonds for this young man or woman,
I would think so.
or a index fund? I would
About-
probably
I
miss
think
this, by the way.
B. I think B.
You're thinking
I go, yeah, I'm going to pick. I'm actually probably going to miss it because my inclination is I should say this guy or gal. I think people should be fully equitized, and so I would have said I'm only going to answer A because I know the test. I'm guessing up to the test.
Oh.
But it was if I was a practitioner, where would I try and get them to do that? But
so the only reason why I said that, why I didn't even look at his age, I just look at what he said that he wanted, and that's why I would go with A.
well, Ingrid, I mean, that's the difference between Ingrid and Dean. She listens to her clients, and I do not. I'll say, listen, young man, you'll thank me.
That's the best thing for his age, but
You'll thank me later, right? No, I think you're right. It's the balanced fund for sure, right? And let's see how we did. Oh,